Alrighty, welcome everyone again on this lovely Saturday. Always an interesting week in the markets. We say this every week now, it seems. Been very volatile, lots going on, but oil is in the headlines again, along with the rest of the market and the outperformance we've seen. So welcome again. And we'll be going through Tamarack Valley today, and then Tourmaline Oil, the valuation session, as we usually do. Just two companies today, and then we'll do a wells update. It's getting more and more important, I'm finding, to be tracking these wells, the latest drills, how the companies are doing, especially in the Montney, the Clearwater, some of the Saskatchewan companies. It's very easy to spot which companies are drilling good wells and which companies don't have good acreage, and which ones will be forced to buy more land as we go and spend money on that into the future. So just want to share that. I did get PetroNinja Premium the other day, so I've been spending a lot of time on there checking wells and logs and all kinds of stuff. So I thought it was a good time anyway to bring it up, and some of the due diligence going on between these companies. So a couple things up front. I'm not an investment advisor, so please do your own due diligence. Please check your own risk tolerance, your risk reward, your portfolio construction. The way I construct my portfolio might be different than yours. I might be taking on more risk or less risk than you, so please take that into account. Everything I share today is my valuation model, the way I look at things, and I find it important to see these things. May not be the same for you, but I'm happy to share this. Again, this template, for anyone that wants to follow along today and actually put the numbers in, is on the website, whitetundra.ca. Scroll to near the bottom under the file section. It's the first file, and it's literally this file without the pre-filled in boxes that I've made already for the companies we're going to talk about today. And the video will be recorded along with the Twitter space. They will both be uploaded, the Twitter space on Twitter, obviously, and the video of the recording here on the website by later today, and then on YouTube as well. So have a look at that. For anything that I kind of skip over today, anyone that's joining us for the first time, a lot of the boxes that I'm filling out, the detailed explanations on them, is discussed in the previous company valuations. We've done, I want to say 35 to 40 of them now. So we've hit a lot of companies right now, which is great. And basically going to try and keep doing these every 2 weeks, along with the macro outlooks every month. And then I want to start doing these due diligence seminars, probably every 6 weeks or so. I really enjoy sharing the due diligence on certain companies and going through in depth what's going on. So keep an eye out for one more of those. I think end of May is when I have the other one planned. So really look forward to that. And thanks again for joining. So we'll get started. So this valuation method is based on the 8 times free cash flow model. It hasn't changed much since we started doing these valuations, but I try to keep it as straightforward as possible. If your background is in finance or portfolio management or valuations, you may find some of the metrics are not exactly as you're used to, but it's designed that way. We're trying to get as accurate as possible, but taking time into account. If you're running 40 companies through this or 80 companies through this, we don't have time to worry about things that matter only 1% or 2% at the end. If the company is not generating free cash flow, I'm not going to bother doing the due diligence, going deeper into it, because there's no point. The company just doesn't make the cash that's required for me to get my dividends, for me to get my share price appreciation at the end of the day. So yeah, so basically what I use this for is a pre-checking tool. It's a relative valuation. So I'm tracking about 60 companies now. I'm up to within the Canadian oil space, and run them through this, see what the cash flow comes out as, and then kind of just go from there and pick the top 5, 7, 10 companies, do a deeper dive on them, make sure everything checks out: management quality, operations, the well performance, the dividend potential, the acreage, the land holdings, et cetera. And then if everything pans out, then go ahead and take a position in these names. Okay, we got some questions already. Yeah, so the completed models I don't share all the completed models just because I do a lot of revisions to them based on certain things. Like we'll talk about this today in the Tamarack Valley portion of it, but basically I do adjust the numbers based on stuff that I know or things that I want to change. So without explanations of that, I don't like sharing the templates. But if you want to email me and you're looking to compare your template to 2 or 3 companies, I'm happy to share a portion of it or those companies specifically for sure. I've sent out lots of them. I just don't like sharing the entire file with 40 or the 60 companies I have in there. But yeah, so we'll get started. So first thing we need, obviously, the name of the company. So we'll start with Tamarack. Login, lots of questions right off the bat. Okay. So the first thing we need is a production.
Yeah, sure. I'm just gonna, I just threw a link into a Slido that I threw up for other questions if people have. So if you're not familiar with it, it's just a sort of a sidecar site where we can put in questions and not fill up the chat.
Okay, yeah, right on, that works too, or we can just keep them on chat, either or. If not, at the end of the Q&A session, we'll go into the Slido and check that out. But thank you for setting that up, Dirk. So the first thing we need is a production, and we always want to look at the latest quarter of production. That's the newest information we have, and luckily it's Q1 season, so we have Q1 results from Tamarack Valley just posted this last week here. So production right there, 41,335 BOE per day. We're going to put that in. We want to also divide it out because heavy oil gets a different price than light oil. Light oil gets a different price than NGLs and gas. It's all a BOEs, barrels of oil equivalent, but they all get different prices. They all make different kinds of money. So thankfully, Tamarack breaks it down right for us. So light oil, 17,868. We'll put that in. The heavy oil we have 7,522, and the NGLs 4,113. So 7,522, 4,113, and the rest is gas. But the way the spreadsheet calculates it, we need to put in the liquids percentage. So basically, add up your oil and divide it by the total production we had. So the total oil 29,503. So 29,503 divided by your total production, and you get your liquids percentage. You multiply that by 100, obviously, and it calculates the gas production for you. Okay. And the next thing we need is the amount of shares outstanding. So for Tamarack Valley, they tell us weighted average shares outstanding, basic shares 409 million. You're welcome to use fully diluted shares. For me, it's only 1 or 2% difference. Again, I don't want to get caught up in the slight inaccuracies that make almost no difference in the end. So I just use basic shares unless there's a huge difference between the two numbers. In this case, 2% doesn't really matter. So 419 is going to go in there. The share price, we're looking at 503 for the share price. Oops. So 503, and we have our market cap. Market cap tells you the total value of all the shares of the company. So Tamarack Valley, all its shares combined are worth right now about $2.1 billion. The next thing we need is a debt. How much debt do they currently have? So right there, net debt. A lot of these information is usually in the MD&A or the financial statements. For anyone that would like to join for future seminars, I do have a mailing list. I send out all these files a day or two before the presentation. So again, if you would like to join the mailing list, just shoot me an email or a DM, and we can get these files to you a couple days before. So net debt, 556 million. I'll put that in there, 556, and we get the total value of the company. So the enterprise value is the total value of the company. The way it's calculated is your market cap plus your debt. So the value of all your shares plus how much debt you have is the entire value of the company. if somebody wanted to buy this company today, that's what it's worth according to the market. And the next thing we need is the next thing that the spreadsheet gives us is the debt to EV ratio. So why is this important? The debt to EV ratio tells you that of the entire value of the company, how much is in debt. So why is that important? Because when oil prices are low, you want a very low debt to EV ratio, because companies with higher debt are more prone to bankruptcies, to not being able to pay off their lines of credits, to breaching covenants if they're carrying way too much debt. On the other hand, my opinion is that as prices rise, you want more debt. It gives you more financial leverage on the price of the share. But again, this is a subjective measure depending on, again, your risk tolerance, your portfolio construction, your risk reward, how much money you're trying to make, the hurdle rate you're trying to hit on your investments. You will be comfortable with a different number here. It's a relative valuation. If one company is at 0.2 and another company is at 0.4, you can compare the two and make a decision accordingly. So the spreadsheet just calculates it for you. It's right there. The next thing we need is a dividend. So Tamarack's dividend is 12 cents a year right now, based on the latest news release. So we'll just put that in there, 12 cents. That means the company needs about $50 million a year to pay the dividend with this amount of shares outstanding. Tamarack also did a recent acquisition using shares and debt, but again, it wasn't material. It was maybe a 2% increase in the share count and $50 million of debt. I'm going to leave it out for now. You're welcome to go as accurate as you want, but I'm just going to leave it out for now. The next thing we need is adjusted funds flow. So what adjusted funds flow tells us is, after all expenses in the company, how much money did they make? So after tax, after interest, all the costs to operate the wells, buying the box of pens for the office lease, the company trucks, et cetera, et cetera. After all its expenses, how much money did they make? So last quarter's adjusted funds flow, right here. Again, an easily built chart. Thank you to Tamarack, whoever built this table. Appreciate putting everything right in here. So adjusted funds flow, 167 million. So I'm going to put that in there. Adjusted funds flow. The next thing we need is free cash flow. So what's the difference? Free cash flow tells us how much money did the company make after all the expenses, so after adjusted funds flow, but also after capital cost. So oil wells decline. They lose production. They lose oil production. They lose gas production. So your production number slowly is declining. What we want to do as a company is at least keep production flat, especially when times are good. You don't just want to decline your production forever. You want to keep your production flat. So you need to drill more wells. You need to frack more wells. You need to complete wells, buy equipment for those new wells. And those we know as capital cost. So free cash flow tells us how much money did the company make after all expenses and after keeping production flat and all the capital they had to spend. So the way it's calculated, adjusted funds flow minus capital equals free cash flow. It's a simple calculation. Some companies, you have to be careful if they're growth companies. If they're growing production by 10%, let's say, I always use all capital cost. So I know it says to keep production flat here, but if the company's growing, I will put the actual free cash flow in there with the growth wedge. And then you'll see later here, we actually can put the production growth in there. If you don't want to account for the growth, leave these boxes blank for the growth, as we'll talk about later, and use whatever number you think is to keep production flat. There's two ways to do it. I like to keep things simple. What did the company actually make? And then I'll actually account for the growth as we go on. So free cash flow, adjusted funds flow, 167, minus capital, 125, we end up with 42 million. So again, 167 adjusted funds flow minus your capital, which is 125, we end up with 42 million of free cash flow. So that's the number we have. The next thing we need now is the hedging impact. So why do we need the hedging impact? So the company made $42 million last quarter of free cash flow, but that's not the operational free cash flow. That's after all the financial changes and the metrics and the hedging. So hedging is contracts that companies make for the future. They will say, okay, I'm going to sell you this much oil per day or per month, whatever, for this price. So this free cash flow that we have, $42 million, is after the impact of these hedging. But we want to know, what does a company make without all the financial metrics? What does it make on a purely operating level? And the reason we want that is because hedging is temporary. It could only be for 3 months. It could only be for a month. It could only be for a year. So as we invest in these companies, we look into the future, the hedging situation is going to change. So we don't want to use Q1's hedging because that was a one-time thing. It's done. Q2 is going to have different hedges. Q3 is going to have different hedges. So we don't want to complicate the situation. We want to know, what do they make on a strictly operational level? So hedging impact, again, it should be in the same file here, realized. So sometimes you got to go and find it. It's known as hedging. It's known as commodity contracts, derivatives, risk management. They call it lots of things. So realized hedging loss, $4 a BOE. So they don't give us the actual number. So we're going to have to calculate it. $4 a BOE. So $4 times, this is how many BOEs they made in the quarter. Hang on. 4 multiplied by, you have your 41,335 BOEs, and then you have you multiplied by your days in the quarter, which is 92 in Q1. It's about $15 million. We need this to be in millions, so I'll just convert this back to millions, 15. However, because it was a loss, negative 15. So again, they lost $4 a BOE for the entire quarter. So we take the $4 multiplied by their BOEs per day, multiplied by the number of days in the quarter. We ended up with a $15 million loss. As we see, it's in brackets, so it's a loss. And losses in here will go in negatives. Okay, great. If there are any questions as we go along, it's probably better to put those in the chat, but for the Q&A stuff, we can put them on the Slido for anyone on the Zoom call. And again, anyone on the Twitter that would like to join for the Zoom visuals, whitetundra.ca, scroll to the bottom under events, there's a Zoom link as we go along here. So we have a last quarter's total free cash flow number. That is the number of how much free cash flow they would have made without hedges, or how much did they make free cash flow on a strictly operation standpoint, operational only. Okay, so the company made $57 million unhedged, if they were unhedged, 42 with the hedging, but at what price? Oil prices change. If they made X amount of money today at this price of WTI, that's going to change if the prices rise. It's going to change if the prices fall. So we need to adjust as we look into the future. We need to adjust these numbers for how are they going to change as the oil prices change. So they made $57 million at what WTI, and they tell us this usually under benchmark pricing is how they label it. So they made $57 million at 94.38. So 94.38 is what WTI oil averaged for the last 3 months, for Q1, I should say. What's the strip pricing? If we were to sell a barrel of oil into the future, so if we're investing for the next year, let's say, and we want to know what price are we going to get right now for the next year, that's known as strip pricing. You sell 1 barrel of oil every month for the next 12 months and give me the average price, that would be known as a strip pricing. So where do we get that? There's a website called rbcrichardsonbar.com. And right here, it gives you the 12-month strip on NYMEX crude oil. 100.57 is where it's at right now. So we're going to put that in there, 100.57. Again, for those a little bit unfamiliar with the price of oil, the number you see on the screen that we trade at is just the price for the next month. That's usually what we trade at. That, okay, if you want to sell oil for the next month, this is what the price is. But if we go into the future, the prices change. They can be higher, they can be lower. It depends what sort of regime we're in, pricing, kind of pricing we're in. And the 12-month strip tells you the price of 1 barrel of oil every month for the next 12 months, averaged out, what's the price? So 157. Because Tamarack produces heavy oil, we also need to look at WCS, which is the Canadian benchmark for heavy oil. So last quarter's pricing, again, it'll be in the benchmark pricing. So WTI got 94.38, 94.38. The differential was 14.60. The differential being how much lower than WTI was WCS selling for. So it's $14.60 below WTI. So you take 94.38, you subtract 14.60, you end up at 79.78, I believe, is what we should end up at. So that's the last quarter's pricing for their heavy oil. Now we need the strip pricing for the heavy oil. So how do we calculate this? There's a website, and again, RBC doesn't give us WCS, unfortunately, but there's a website called cmegroup.com, and they will give you the differentials every month for the next 12 months. So again, I add up the next 12 months. So 12.75, 13, blah, blah, blah. Out of the next 12 months, divide by 12. I end up at roughly $13 differential. So you take your WTI strip pricing, subtract the differential. So I'm going to just straight subtract $13 from 157. We end up at 87.57 for the price of WCS. Now, Tamarack also sells NGLs. They had roughly 4,000 barrels of NGLs, natural gas liquids, so your propanes, your butanes, all that stuff. So what did they get last quarter? Again, benchmark pricing. We'll go to the same place for their natural gas liquids. They got about $56.21 Canadian. We're going to convert that to US dollars. So 56.21 divided by the exchange rate. Roughly $43 US is what they got per barrel of NGL. Same thing. What's the strip pricing of NGL? I usually go, again, RBC gives us a good number, a rough number for NGLs, 51.28. This is pricing in Texas. It's not really Canadian pricing, but again, I'm not going to get caught up in little things that don't really matter. So I'm just going to take this number, 51.28. It sounds pretty reasonable because WTI is up roughly 5% from the last quarter. Maybe this number is a little bit high. You're welcome to put in your own number. The spreadsheet is very flexible. You can put in whatever number you want. If you think there's a better estimate out there, definitely feel free to use that number. But this is basically all we need. We put in the exchange rate right now is about 1.291. Gas price, we did the oil last quarter's and strip pricing. We need to do the same for gas. What did they get for gas last quarter? They got about, I'll use the daily index, 471. Put that in there, 471 for last quarter. The projected gas price, again, I use strip pricing, one molecule for the next 12 months. What price am I getting? Divide by 12. And the place where we get that is there's a website called gasalberta.com. So it gives us the pricing for the next 12 months. I added up, divide by 12. I end up at roughly somewhere around 775 is where I end up, including the drop we had on Friday. Before that, this was a little bit higher, but I think it's 765 actually. So we'll take that. And we're done. That's it. That's all we need to do. And once we do this for one company, it's very easy to take numbers for the next companies because we already have the pricing, we already have the exchange rates, we already have a lot of the information as we do the next companies. So that's that. So where do we end up? There's two charts / tables that the spreadsheet puts out. The first one is our 8x FCF model. So what does that mean? I'll go through the numbers first and then maybe explain. So what it's doing is taking the last quarter of free cash flow and it's annualizing it to give us the free cash flow for the next year. Then it gives us a free cash flow yield. The free cash flow yield is how much percentage of your enterprise value, so your entire value of the company, how much percentage of that are you making in free cash? And what's free cash? Free cash is cash left over to pay dividends, to pay back debt, share buybacks, special dividends, asset acquisitions, land acquisitions, etc. This is excess money that the company makes to do whatever it wants with it. Does it want to give it back to you as a shareholder? Does it want to expand its production? It wants to grow. What do they want to do? It's all extra cash. So the way I think of it is the company could today decide to pay this free cash flow yield as a dividend, a strict dividend, as long as they're happy with their debt metrics, they're not doing any share buybacks, they're not doing any asset acquisitions, they can pay back this number in strict dividends. Okay, so I got a question here. I couldn't figure out what they were stripping out of these barrels. Yes, so the strip price just refers to the price of the next 12 contracts. So for the next year and divided by 12, and we get the average price we'll be getting. Yeah, great point. Okay. So yeah, so I'll explain this here as we go. So the way the spreadsheet does it is it gives you the free cash flow yields at all kinds of oil pricing. So from $40 to $120. When I first started this spreadsheet, oil prices were in the $75, $80 range. And I thought 120 was a big reach. Well, it doesn't seem like a big reach. So I might have to adjust this as we go. But at these oil prices and the strip gas, which is the number we put in here, these are the free cash flow yields. The FCF on an 8 multiple, so we're basically taking the free cash flow and we're multiplying it by 8. That's the value of the entire company on the FCF times 8 model. From the value of the entire company, we need to subtract debt to get the value of the shares. So we subtract debt, we get the valuation of the equity only, and then we divide it by the number of shares to get our fair share price. That's out there. So, okay. Yeah, so why do I use 8 times free cash flow? Why is it something that's used in the industry? Are we there yet? No. Do I think we're going to get back to 8 times free cash flow? Yes. And that's the reason I use the model. And why? The reason of the why. Because I think that as companies deleverage in the next, they've already deleveraged over the last, call it 6 months, 12 months. Their debt metrics look really good already. There's a handful of debt-free companies in the oil and gas space. As they're happy with that, as the companies become less and less riskier in a way with lower debt profiles, we look at what kind of returns can they make. Canadian oil and gas companies are talking about returns to shareholders. That's a new mantra. And I'm thinking, how much return can they give me? What am I happy with? So the number that I calculated that I'm happy with is 12.5%. I want a 12.5% yield. I want a 12.5% return, which gives me a 5% share buyback. It gives me a 5 to 6% dividend, and it gives me that 1% for extra land acquisitions. If they want to drill a couple extra wells, it gives me that extra boost in there. So 12.5% is what I'm looking for. And the way the 12.5% goes is if I get 12.5% for the next 8 years, that adds up to 100%, and I'm getting the entire value of the company back in 8 years. That's where the 8 comes from. That's why it's free cash flow times 8, because I want the entire value of the company back to me in 8 years which works out to 12.5% per year. Now, do I expect everyone to use an 8 model? No, because some people might want to use free cash flow times 6. If it's a smaller company that maybe we don't know as much about, maybe we want to use free cash flow times 6. If it's a company with a lower reserve life, as was mentioned in the chat, maybe you want to use free cash flow times 5, times 7. If it's a company with huge reserves, they've spent all their capital up front and they're basically raking in money, you might want to use free cash flow times 10, times 12. It's very flexible. The reason I use 8 is because I think a year from today, a lot of companies will trade at that roughly free cash flow times 8 model, especially if they put out dividends. If they're trading at a 24% dividend, like some of these companies can at current free cash flows, these share prices will normalize. They will come back to the free cash flow times 8, which is a 12.5% yield. That's how I'm thinking about this. Now, the one thing I'm going to mention here on Tamarack Valley, when I said earlier in the presentation that I don't like sharing these spreadsheets, the whole thing, because I do make adjustments. So the question arises, what kind of adjustments do I make? And I'll mention one here right now. So if we look at Tamarack Valley's 2022 plans, what are their plans for 2022? What they're telling us is they're going to be spending for the full year, including the latest acquisition, they're going to be spending around $290 million in capital for the year. That works out to roughly 75 million a quarter is roughly what they should be spending on capital. But the oil field doesn't work like that. They don't just spend $75 million every quarter, because some areas you can only drill in the winter. Some areas they're waiting for permits. Maybe on the new acquisitions, they're waiting for permits. They can't spend the money yet, or they spend too much money in a certain quarter, and it kind of flip-flops up and down. So yeah, great question. And this is exactly what I'm talking about here, Nathan, and the adjustments that I make. So what's happened? They should have only spent $75 million. Instead, if we remember from our financial statements, they ended up spending $125 million. So they spent almost 2 quarters worth of capital in just 1 quarter. And you got to think, okay, can we take this number? Is this number accurate for the quarter? It is, because they actually spent the money. But when we're modeling Tamarack Valley out, what we're going to see is Q1 is going to have an artificially low free cash flow because they spent way more of their fair share of capital in Q1 as opposed to the other quarters. So what's going to happen? Q2, Q3, and Q4 should have a relatively abnormally large free cash flow. But we can't be modeling companies with ups and downs in it. We need to normalize it to what's actually going to happen. So what I'm going to do is I'm going to assume that they only spent 75 million for the quarter, because that's the yearly budgeted spend. That's what they're going to spend. When you look at Tamarack Valley on an yearly basis, they should have only spent $75 million a quarter. They spent 125. The free cash flow in Q1 is artificially low. We're going to adjust for that. So instead of 125, I'm going to assume they spent 75, which means they should have made an extra $50 million of free cash flow this quarter if they spent their budgeted amount. So what am I going to do? I'm going to add 50 million straight to free cash flow. So look at these fair share prices. They look really, really bad. And like at $90 oil, it's below the current price. And you're thinking, is this a good investment? That's what I was thinking. But after I did this adjustment, I added the $50 million to free cash flow. We see the prices change big time. We're looking at strip pricing, about a $10 share price, about a double from here is what the 8 times free cash flow model will get us. When people say that it's trading at this value of WTI, this is what they mean. On the 8 times free cash flow model, we're trading at a roughly 80 WTI fair share price. That's what they mean. When people say at this price, the equity is worthless. This is what they mean. At $60 oil, the shares are basically worth zero. The company is not generating free cash flow, just enough to pay off debt and basically give nothing to the shareholders. So at that price, oil price, the value of the shares are zero. The table does everything for you. It's just about understanding what it's telling us, and we go from there. The question came up, why are these prices less than what I have on my target sheet? Because we haven't accounted for the growth yet. This is based on Q1 numbers where they had 41,000 BOEs. Tamarack currently is making 47,000. So we will adjust for that growth after as we go, and that will bring these share prices very close to what I've put on my price targets sheet. Okay, a couple of questions here. So why wouldn't you assume that the CapEx projections are too low and they will be forced to spend 125 million per quarter? So great question. Maybe they end up spending way more than their budgeted spend, and they end up spending 125 million per quarter. The reason that I can say pretty much guaranteed that's not going to happen is just my personal experience in the oil field, working in it, running these valuations. That never happens. Companies don't inflate their capital budget by 60% without any reason for it or without explaining why. And this is a very common thing that happens. In Canada, there's a lot of winter drilling between, let's say, November and March. So companies usually spend a lot more money in Q1. If you look back for the last 5 years, the exact same trend will be seen, where companies spend way more in Q1, and then the spending moderates into Q2, Q3, and then Q4 might see another slight uptick. But I can basically guarantee that Tamarack is not going to end up spending 125 million per quarter for the entire year, unless they say they're going to go for a production growth cycle or something, which I highly doubt it with a company so conservative. But yeah, thanks for the question. Okay, so where are we here? Can you talk about marginal versus fixed operating cost? Okay, do you think about? Yeah, so usually what you will find is that as production increases, the operating cost per BOE decreases. So the netback actually goes up. And there's two reasons for that. One is the wells just make way more production per well. So if you're operating 50 wells and they make 20 barrels each, okay, and then you drill a new well that's making 500 barrels, okay, well, now you're looking after 21 wells, but your production per well is way up. So operating costs per BOE usually go down. Also, newer equipment is easier to operate. You've spent the money in capital, so it doesn't show up in operating cost. Yeah, great question. Awesome. Production break even at 60, average used to be 50. Yeah, so the production break even is different from the company break even, because the production break even is just the on-site, on-field operating break even. You then need to pay salaries, you need to pay tax, you need to pay interest on your debt, you need to pay for, you know, a few other things, and the company overall break even does come up. Don't get fooled by operating break evens. It's not really a good metric, and it can be easily misrepresented and be very misleading. Look at shale companies as an example, talking about $25 break evens, and then they end up losing money at $40 oil and $60 oil environments, right? So operating break even is a little bit skewed metric, which I definitely wouldn't use. Yeah, informational asymmetry for sure. Yeah. Okay. Right on. Okay, so what's the difference between your price targets and the fair share price? There's no difference. Like when I put out my price targets, I'm using these exact numbers, except after accounting for hedging and after accounting for production growth. So I will get to that here in 5 minutes. Tamarack call options just don't have liquidity. I tried buying some of them and I got 5 contracts or 10 contracts for like $300. So unless I see liquidity there, I found that Tamarack Valley, you actually can't can't even get the options. Like even if I bid over what the ask is, it's only 5 contracts that get filled. So I'm a little wary of going into that because it's basically wasted money. I can't even sell that contract now, and I'm stuck with this. It's not huge money, but I'm stuck with this $400 thing in my portfolio, and I got 2 of them with Tamarack, and I stopped buying options after that, and I can't even sell them. So basically, if they're in the money when the time comes, I'll exercise them. It's basically all I can do at this point. But so let's keep going here. So the next thing we need to do is we took hedging out of the equation, the Q1 hedging out. Now we need to put the Q2, Q3, Q4, and 2023 Q1 hedging back in, because those are the actual hedging for the next 12 months. So how are we going to do that? If we go to their PowerPoint presentation, they have a slide on hedging here. Right here, they tell you exactly what's hedged, and you will need to know a little bit about hedging, how the contracts work, put options versus callers versus three-way callers. Some of them are now just selling call options, which is strange, but whatever, they're doing all kinds of things. So to each their own, and basically we're going to put the hedging in. The one thing with Tamarack that I've messed up in the past, and thanks to those who brought this up to me, is that a lot of their hedging is put options. Put options is not really hedging. It's just buying a floor. So if the price of oil is above this price, that doesn't mean that they're forced to sell oil at that price. That means that's the minimum price they will definitely get if the price of oil collapses. So keep an eye out for these put options. We don't put them in the hedging spreadsheet because they're actually not going to exercise these options. These are just gone. Like it's just an option that is going to expire out of the money. That's it. They lost this $3 that they paid upfront for the premium. Yeah, so, okay. So basically what we need to do is average it out. So they've made hedging contracts to sell 4,250 barrels at this price and 2,500 barrels at this price. Again, you need to understand how these contracts work and why I'm picking this price rather than this price, why I'm picking 73 as opposed to these. And I could go on a whole different topic on that, so I'll leave that and let the people do some reading instead, because it's very complicated. It can get complicated if the prices are not above the highest price. But anyway, I took this, averaged it out. I took this, averaged it out. I took the next 4 quarters. There's some hedges they took from the deals they've made. Keep in mind, USD per barrel, Canadian per barrel. I don't know why they do this and not just put it in one currency and makes it easier for us, rather get us all complicated. But anyway, so we just need to do a simple average out on the hedges. 4,250 at this price, 2,500 at this price, 500 barrels at this price. What do we end up with? My numbers may not be the latest, but I've done this already. And basically, I'm just going to copy it in the sake of time. But if you run the same simple averages, you will end up at the same numbers here or close. Gas pricing, I'm going to leave it out. They're not a big gas producer. Again, I don't spend time on inaccuracies. When I do my price targets on the website, I will put these gas prices in. I will put every single data point I can, but for the sake of this presentation, I'm just going to leave it out. We know how much money they're losing on hedging based on the price of oil right here. You can get the same for gas. This is just some adjustment numbers, which are more, if you want to understand them, I'm happy to explain them in a different seminar, but it's just showing the raw calculations. So people don't say you're just manipulating stuff and making up numbers. It's all there in front of you. And the next thing we need is production growth. So in Q1, Tamarack produced 41,335. What are they going to produce for the next 12 months, roughly? To understand that number, we look at their 2022 budget again. I take the midpoint, 46,700 is the midpoint here. And compared to their Q1 production, it's roughly 5,400 BOEs higher than that. And these 5,400 BOEs, how much money are they going to make per BOE? That's what we need to know. So we go back to the statements, and I usually take the operating netback number. So they made roughly $48 a BOE in Q1. Q2, prices are going to be a little bit higher. Gas prices are going to be higher. They can get some operational efficiencies, as I'd mentioned, when they increase production. But on the production growth, I'm going to be conservative. I'm going to use the same number, 4838 is how much they're going to make on these extra barrels, BOEs. Okay. So what's going on here? Go through the questions. The calls on the three-way callers are long. No, those are short calls. On a three-way caller, the top price is selling a call option. So let me just go back. Maybe it even tells us that. But yeah. So on the three-way caller, there's a bought put, a sold put, and then it doesn't say sold call. So I'm gonna look into this again. Yeah, thanks for bringing that up. But mostly three-way callers, the highest price is a sold call. So someone has the option to buy it off them for 73, which they will exercise. So it's strange that they don't mention that, but they do say it's a reverse three-way caller. So again, another mistake on the hedging possibly here. So Tamarack, thank you for doing all kinds of hedging so we can look into it. But if that's the case, that's another few barrels gone, which I will adjust my targets on the Q1 based off of that after verifying. But that's that. We're done. We have ended up with the price targets that I've put on my website. We see at $100 oil. Previously, we were looking at 981 as our fair share price. After putting hedging in, after adjusting for the production growth, we end up at 1158. So what is that? 130% roughly premium is what I'm looking for from the current share price. And basically, what do? I run these for 58, 60 companies. I pick the top ones that are giving out cash flow and do my deeper dive, do my due diligence, and then make an investment. That's basically it. It's a relative valuation tool. So anything that is consistent between the industry doesn't need to be taken into account because we're using the same metric. So if every company in the industry has a 10 to 12 year reserve life, it doesn't matter because it's all taken into account the way this is built. When we look at free cash flow metrics, the decline rates are taken into account. The capital efficiencies are already built in to a free cash flow model. Now, some people prefer to use adjusted funds flow models. They use adjusted funds flow times 4. As to why to use which one, I'll refer you to my previous videos on this topic. But basically, I've also put the adjusted funds flow times 4 in here for anyone that wants to use that modeling and the fair share price. As you can tell, it's a very conservative model compared to the 8 times free cash flow model. And in many cases, we're already at 4 times adjusted funds flow / cash flow in a way. So we're done. There's some 2022 adjustments that I usually make. So 290 is a capital program. If there's any other free cash flow sources you think the company has, you can put that in there and you end up with a projected free cash flow yield at strip, hedged and then unhedged. And it goes to 2023 as well, if you want to go that far and fill in the boxes. And what we have here. Okay, so a couple questions here. How much share dilution is too much? You want to look at a share dilution in terms of the in terms of the production and in terms of the cash flow. If the company has diluted way more shares and your production per share and your cash flow per share has gone down, that's a red flag. If they're accretive, and accretive is again a manipulated word, a misleading word, but if you find that the share count has doubled, but the production has gone up, 3 times, and the cash flow has gone up 5 times, that's probably okay with no matter how much share dilution it was, up to a point, obviously. Might not affect TVE, but why not use a higher gas price? I'm already using $7.65 for the projected gas price on the strip. If you're asking why I don't use higher gas prices here on the price targets, when I put my Q1 targets out here in the next week or so, I will adjust these up $1. So I don't want to go too crazy on the gas price because we haven't seen it sustain up there yet. And although the macro agrees with it, you don't want to go crazy either. So I'm just going to go up by $1 and leave it in there. And as I understand it, the third leg is a long put. Okay, yeah. So I'm going to look into the hedging more. It used to be the hedges were simple 3-way collars, costless collars, but that seems to no longer be the case. So I'm going to do some more digging into that and check it out. Yeah, for sure. Thanks for bringing that up. Great. And we're basically done. So I'm going to go into some of the extras on Tamarack Valley that I'm seeing. Why did I buy a 10% stake in the White Tundra portfolio? The cash looks great. The acquisitions, I think they were paid still for the ones last year, but at a $110 oil and $8 AECO, the overpayment doesn't seem as bad now that we are where we are. So what's going on with Tamarack that really gets me? I've been talking about well outperformance for a while. I've been buying companies that outperform on their wells a lot. Surge, Whitecap, Spartan Delta. I've been really targeting those things. That I want companies with the best acreage that are going to get the best performance, and they're not having to drill hundreds of wells and pay inflation on them, pay the extra labor, parts, etc. on them. I want companies with the best acreage and the best wells. So, okay. Yeah, so again, the production is going to be a little bit higher than 46,700 this year. Not this year, for the next 12 months. Why is that? Because if they're going to average 46.7 for the year, and the first quarter was 41.3, obviously the next 3 quarters are going to be higher than 46.7. It's going to be in the $48,000 range. But again, that's 2%. If we start doing those kinds of calculations on every company, we could only look after 8 or 10 companies. We want to identify the best companies. We need to do these calculations for 40, 60, 100 people in America. You need to do these calculations on 300-400 companies to find the best ones. So we cannot get caught up on these little things. Inaccuracies are going to be built in to the way this is. And if there's a 10% inaccuracy, the company should still compete on cash flow. If it's going to be the top 5 or top 7 pick, it will still compete on free cash flow at the end of the day. But I do like where you're going with this. When I do my deeper dive, yeah, now that I have Q1, before I put out Q1 price targets, I would look at these things, try and make adjustments, but again, I don't want to spend hours and hours on a single company when it makes a 0.5% difference at the end of the day. So just keep that in mind. I'm a one-man show here, so I can't do everything, unfortunately. But thank you for bringing that up. I will talk about this as well. Sridhar, give me a sec. So why do I like Tamarack? They've got the 3 best plays in North America right now for payout. Why is payout important to me? Payout is important because the faster the wells pay out, the more the free cash flow is with the company right away. The more they can use that money to drill the next well. They're not waiting for the wells to pay out and having to take on debt, having to They can't pay dividends because they don't have clarity to cash flow. As soon as they drill the well, within 3 months, the money's paid back. So they have clarity. They know, okay, this well panned out. We've paid it off already. The rest is all free cash for the rest of perpetuity. That's what I like to see. And that's what I'm seeing. The Clearwater, Martin Hills, the Clearwater Nipissing, and the Charlie Lake are 3 of the top 4 right now in North America, hands down. And where is Tamarack Valley? They've got, it's this dark, hang on, this one here, like this teal almost color. They've got the Peavine next to Baytex. They've got Nipissing next to Spur, I believe. Here, is that right? Where's Spur? Yep, next to Spur. And then they've got these emerging plays, Jarvie and Perivale. So they've got lots of land in the Clearwater. They've got some in Martin Hills here as well, but less. So anyway, 3 of the top 4. The Frobisher is in there. Keep this in mind. I'll talk about the Frobisher as well as we go. Okay, so a couple questions. Are you seeing an increase in the output of the current wells from the rest of the year? Yeah, Tamarack's wells are coming in really, really, really strong, for sure. The Clearwater, they're not as good as Baytex's wells. They're not as good as some of Spur's wells, but they're still good. And they still got paybacks like less than 3 months at today's pricing. The reason I sold my Whitecap equity is because I ended up buying a lot more call options in the last 2 to 3 weeks. So I've got so many Whitecap contracts that I thought, yeah, I better exit the equity. I didn't have a huge position in the equity anyway. So I let the equity go and I kept all my options. So that's the reasoning behind that. I didn't shift from Whitecap to Tamarack. I just have different reasoning for both, but yeah, thank you. Yeah. And yeah, my portfolio on the website is live as of May 4th, but there has been a couple changes, so I'll update that as we go. For the people on Twitter, somebody asked me to say the fair share prices because you can't see it, obviously. So at strip, $12.53, $80, $9.16, 90 is $10.74. At $100 oil, it's $12.31. 110, $13.88. At 120, it's $15.45, so about a triple. At $70, $7.59 is where I have it. Couple other things on Tamarack. So they are right next to Spur. Spur is the best operator in the Clearwater by far. And to have land next to them that's been delineated in a way and they can work with Spur is a great place to be. So we look at Tamarack's wells. The wells closest to Spur's land here, I believe that's Spur anyway, are coming on at 200 plus BOEs per day. So pretty good wells. If we look at them stepping out a bit, the well only came on at 70 barrels per day. It was only a 3-leg well, but you know, it gives you an idea that the Clearwater is not just one massive thing with the same well quality all across it. So the fact that Tamarack has Peavine, Nipissing, Martin Hills, Jarvie, Perivale is great because I get to let them delineate the land, find the best ones, the best sections, and accelerate development on those sections. They don't have to go out and buy anything else now. They're basically, I would think, are done in the Clearwater with their land acquisitions, with the company acquisitions. We look at Clearwater well payouts at strip pricing, 2.5, 3 months. That is pretty much top tier. It doesn't really get much better than that. Even at 55 WTI, they pay out in less than a year. You can't say that for many formations, if any others at all. The other thing in the Clearwater is, so far the Clearwater has been mostly just straight oil drilling. That's all they do. They haven't done any enhanced oil recovery, but it's starting. And who's the one doing this? Tamarack Valley, along with Spur a little bit, but Tamarack's really pushing the water flood in these acreages that they bought from other companies. So here's the 2-step water flood pilot. We see the well came on at about 150 barrels a day. It had started declining about a year into its life cycle. And once the water flood got fired on, the well has not declined. It's been producing at 120 barrels a day for the last, almost a year now. It's been almost a year. So that is really a really, really good sign. If all they have to do is water flood and drill injectors or convert producers to injectors and they can keep production flat, that is awesome because water flooding is relatively cheap. It's way cheaper than drilling new wells, acquiring new land, et cetera, et cetera. So we look at the potential water flood area. There's quite a few sections in there that are screening well for this water flood. And they're using a kind of a different design here. They got 2 producers and 1 injector between every 2 producers. So they've obviously done some work on it. They're not using the conventional water flooding techniques. They're trying out new things, which just fantastic. It's really great to see because that means they're going to find the best way to extract the most oil from these sections and keep them running for a long while, keep the production flat. That's exactly what you want. You don't want the company, they have to drill new wells, but they also are suffering with a huge decline on their existing production. That kills a lot of companies. The decline rate on their existing production can really have a hammering impact on the companies. But anyway, I digress. So per section, Tamarack is figuring with the water flood, they can make roughly $26 million of NPV at $70 oil per section. And if I'm not wrong, Tamarack has 200-300 sections. Yeah, somewhere around there, 200-300 sections in the Clearwater. So on a fully development cycle, take 300 sections, multiplied by 25 million NPV per section at $70 oil. We end up with a number way bigger than their EV just on the Clearwater, let alone all their other stuff. So what's the other stuff? It's the Charlie Lake formation. Charlie Lake up in Grand Prairie. It's, if you look at the previous chart, it's the 4th best payouts in North America so far, according to the latest. And they're drilling monster wells in the Charlie Lake. Like this company in the Montney, or not the Montney, the Charlie Lake is doing really well. They're acquiring land, they're acquiring sections where they can. They're right next to Tourmaline, which is pretty interesting. And drilling great wells. Let's look at the top other formation wells rig released in the last 12 months by cumulative oil and liquids. Tamarack's got 4 of the top 4. It doesn't really get any better than that. In the last 12 months, if we take out the Montney and the Duvernay and all those formations, we look at other formations like the Duvernay's on there here too. The Duvernay, we look at the Charlie Lake, we look at other formations. Tamarack's got 4 of the top 4. They've got 6 of the top 10. So they've got 6 of the top 6 wells in the Charlie Lake. So it doesn't beat that. And we look at February 2022. So we're looking at the new wells now, not the last 12 months, but the latest wells. They've again got 4 of the top 9. They've got 2 of the top 5. So it's not just the older wells. The new wells are coming on very, very strong, paying out at exceptionally great rates. And once I saw these numbers, I said, okay, so this company is kind of ready to rock. Like the share price has been lagging for a while. It's trading way below its fair share price. They're drilling monster wells that the market isn't really focused on. They're not paying attention. They've got a ton of land, which land is getting more and more valued now. We see more companies doing land acquisitions, doing asset buys just for the land. So just keep that in mind. This is the latest wells again. This is from Raymond James, I believe, whereas these results are from RBC. Seeing great things again. Tamarack's got 2 of the top 4 brand new wells in the Charlie Lake. So loving that. And I just want to throw this out there because people keep asking me, is Tamarack done with the acquisitions? I think they're done in the Clearwater, but there's this company that's very close to their Charlie Lake acreage in Gordondale. You see the land positioning here. And basically, these Tamarack wells that I'm showing you on this map are right here on this map. So this company, it's a private producer. So I think they could make more acquisitions. Tamarack hasn't been shy about making acquisitions of private equity-backed companies. So I think they do make another acquisition in the Charlie Lake, Gordondale, Valhalla area in the next 3 months. The Clearwater, I think, is basically done at this point. And they're going to be facing lots of competition in the Clearwater. So at some point, you can't keep overpaying, even if it's slight overpayment, because it does end up making a difference at the end of the day. So yeah, that's that on Tamarack Valley and why I've taken a position, the things that I'm seeing here, and the valuation model. So if there's no questions on Tamarack, we'll move on to Tourmaline here. Okay, perfect. So we'll delete everything here and move to Tourmaline. And again, anyone on the Twitter space that wants to join for the visuals, whitetundra.ca, scroll to the bottom under events. The Zoom link is there, and follow along the actual numbers as we go. And for anyone on the Zoom that wants to do the Tourmaline valuation with us, the Excel template is on the White Tundra website. Again, scroll to the bottom under files. It's the first file, and it's the exact same template that I have here. And you can get some practice if you would like putting numbers in, but move to Tourmaline. So exact same spreadsheet, exact same numbers. Tourmaline, they also just reported, which is great for us. And we'll go to the top of the MD&A. The MD&A file usually has everything we need: management discussion and analysis. Sometimes we need the financial statements file, but not often. So production, we'll start with production again. Total produced volumes, 503,166, 78% gas, 22% liquids. So 503,166, 22% liquids. And what are they producing? So we have oil and condensate. We'll go into the light oil box. So we add them up. So it's about 44,043. Dirk, we got another attack here from the bots. So please, or no, never mind. All good. So 44,043 NGL. We have 69,526. So put that in under NGLs, and the gas is pre-calculated, so we don't need to do anything there. And the next thing we need is the shares outstanding. So go up. So as of March 31st, shares outstanding again 334 million. We throw that in there. The share price, Tourmaline stocks. So 7207, put that in there, 7207. And it's pretty straightforward. Once we know how to do one of these, it's just cut and paste. We find the metrics we need, we put them in there, and it should take less than 15 minutes a company just to do the main numbers. So net debt as of March 31st, 769 million. I'm going to put that in there. One thing to keep in mind with Tourmaline and some other companies, the net debt is not actually their net debt. And why is that? I'll just address this right now, because Tourmaline owns 36% of the shares in Topaz, TPZ on the TSX exchange, which are worth $736 million. So that should be counted against their net debt, but they don't. They don't count it against their net debt. If we do count it against their debt is basically zero, right? Because their debt is, their debt is 769 million, and they own roughly that worth in Topaz shares. So one thing, it doesn't make a huge difference because it's not a huge, debt isn't a big component to their EV anymore. But when Tourmaline was at $20 or $30, it was. And this investment was way more important. Now it's less important. Yeah, they do mention this in the presentation. The annual dividend right now, I believe, is 80 cents a share. I'm gonna put that in there. Very conservative on their regular dividend. They like the special dividends, as we know. Adjusted funds flow is the next thing we need. So same spreadsheet. We look for adjusted funds. Nothing there. So funds flow, no, it might be known as cash flow in here. Sometimes you got to find it. Like, it's nice when they have it on the same table, but a lot of companies don't. So cash flow, 1076 million is what we're going to put in there. So 1076. The free cash flow number, they don't actually tell us the free cash flow in the MD&A. So we'll go to their news release, which says record quarterly cash flow of 618 million. So put the free cash flow in there, 618 million. Hedging impact. Do they give us the hedging impact? Nope, they don't tell us in here. So we're gonna have to look for it. And again, hedging is the hardest one to find because it's known as, well, there we find it right away. Always works out like that. So 89 million. It's hard to find because it's known as hedging. It's known as risk management. It's known as derivatives, commodity contracts. It's got lots of names. So sometimes you're just searching for a bit, but that's that. Now this sheet here, the last quarter's pricing, et cetera, I'm just going to copy it. It's basically going to be the exact same. $1 or $2 here and there, not important. Again, if you would like to be more accurate, please feel free. That's why the spreadsheet is open to put whatever numbers you want, but sake of time, right? It's about what's your return on time on doing these valuations, and how serious are you about the valuations you do. So, whoops. So Tamarack Valley had 471 on the gas. Right now, gas is about 765. Put that in there. If you think gas prices are going to be $12 for the next 12 months, you put $12 in there. It's completely flexible to whatever you want to do. That's that. The exact same tables. We see the free cash flow yields. We see the adjusted funds flow method, and we see the fair share prices. That's pretty much what it is. We're going to put in the hedging. So I'm just going to go to my pre-filled in spreadsheet. We put in the hedging on the oil. We put in the hedging on the gas. Again, be very careful in the hedging. I myself get sometimes confused with the gas hedging. It's just all over the place with the way these companies hedge their gas. Different markets, different currencies, different units. Some are in MCF, some are in MMBTU. And I'm going to, again, leave it up to you if you want to adjust the units, if you want to adjust everything, or you just want to throw a number in there that's 90% accurate, right? When I do my price targets, I like to be 99.9% accurate. But for this valuation session, because I haven't run Q1 numbers yet, with the actual numbers, I don't have the actuals. So this is just my rough estimate from what I have. Production growth. So Tourmaline in, where are we here? Tourmaline in 2022 is guiding to 500,000 BOEs per day. Yeah, 2022 production forecast, they've actually upped it. It used to be 500,000. So that's 3,000 BOEs lower than what they produced in Q1. So their production growth, I'm going to have to put a minus in, and I put the net back in. Again, I took the net back from their operating net back for Q1. Put that in there. We end up with the fair share prices after hedging, after production growth / decrease. And we put the capital program in for 2022. We end up with the free cash flow yields. That took us less than 10 minutes, 10, 12 minutes to do Tourmaline. once we know what we're doing, very fast. It's very quick. It's easy to compare 30, 40, 50 companies. It's just about knowing the spreadsheet, what it's telling us, and how to put the right numbers in. I will go back, so their capital program was to spend roughly $300 million a quarter. What did they end up spending? They actually spent 475, 460 roughly in Q1. This again should be adjusted. I'm not going to say it has to be adjusted, but when I do my price targets, I will adjust it and bring it back to that $300 million average. So I would, instead of 618, it should be roughly 776 that they should have made. And the price targets will adjust accordingly, right? But I'm going to leave that to your discretion, how much you want to adjust that, how much you want to play around with it. I do adjust them all to what I think the average capital expenditure should have been for Q1. If you want to add 10% inflation to that, you do that. If you want to add 15%, you do that. It's totally flexible, to each their own. Okay. So a couple things on Topaz or Tourmaline. I talked about the Topaz investment. It's worth $736 million. Tourmaline is also receiving some money from the dividends. Not huge. In fact, it's nothing. It's peanuts compared to the value of the company, but still, just something to keep in mind. Tourmaline basically owns everything. We need to keep this into account. They are by far the biggest gas producer in Canada, as we see here, about 2.3 BCF per day. CNRL is less than 2, and then ARC Resources is a third at about 1.3 BCF per day. Billion cubic feet is BCF. And Tourmaline basically owns everything. We need to accept this fact. They don't need to acquire anyone. They have 75 years of drilling inventory already. They made a lot of great acquisitions in 2020, 2021, which has served them really well, especially with the rising gas price. Like, people think Penny Pony was a steal. Go back and look at some of Tourmaline's acquisitions. They may not be right up there, but Tourmaline made way more of them and bought way more production. So probably ended up better at the end of the day than CNRL did. But anyway, they own land, they own production, they own wells, and they own the facilities. They own all these gas processing plants all over the place, oil terminals. So a little bit different than other companies in that they actually own billions of dollars worth of land and facilities even before the production comes into account. But look at where Tourmaline is in Canada, 2.3 BCF per day. They're the 5th biggest producer in North America. So as the natural gas market globalizes, as companies, these LNG terminals, they want to deal with bigger and bigger companies, Tourmaline is right up there. When there's LNG contracts being made, when there's takeaway contracts being made, scale is key. In the past, it didn't matter because you could be a 40,000 BOE a day producer of gas and sell to your localized AECO market or Washington State market or California market. It didn't matter. Now it's going to matter. Scale is going to be huge in the gas market as we go along. Tourmaline is the biggest producer in Canada. They're the 5th biggest producer in North America. That's really all we need to know. There's a bonus in there almost that maybe the market does realize, maybe they don't. So yeah, great point, Dirk. So I think oil assets are not getting value past 15, 20 years, but I think natural gas assets should get value even 70 years down the road, because that is going to be the fuel of the future, really. Other than oil, other than places where natural gas can't displace oil, it will probably end up displacing oil. Look at Saudi Arabia. They're converting all their fuel oil usage to natural gas. That's why they're drilling their Jafara field to get that shale gas. So with oil, I would agree that, okay, maybe oil 60 years down the road, you can't give it value today, potentially, but natural gas should get value even way further down the road, especially North American gas. It's the cheapest gas to produce. And if we have LNG terminals, it's globalized. So keep that in mind. The other thing with Tourmaline, liquids growth. So their liquids percentage in 2021 was maybe around 18, 20%. 2022, it's gotten to 22%, and it might continue to get higher as we go. This is one of the adjustments, again, that I make on some companies that are drastically adjusting their gas oil split within their company. So at $8 AECO, it means less, but at $3 AECO, it meant a lot more. If they made 20% oil versus 25% oil, it meant a lot. Now a little bit less, I still do the adjustments. There's a question here on how does Tourmaline compare to Birchcliff? Birchcliff is an unhedged 70,000 BOE a day producer. They generate more free cash flow? It's probably very, very close. Cleaner balance sheet? No, I think Birchcliff has more debt to EV than Tourmaline, but that's almost a good thing because it gives them higher financial leverage, in my opinion. Well, it does. As far as which one you want, I really can't answer that question for you. I look at free cash flows and all this, but at the end of the day, you want to be in the biggest producers. That's where I would like to be on the gas market, really. The non-condensate gas market, I should say. If you're looking at Tourmaline, you're looking at Birchcliff, Peyto, Crew, well, not Crew anymore, but Tourmaline, Peyto, Birchcliff, the strictly gas producers for the most part. I think scale is going to matter big time as we go here. So just my opinion on that. What else does Tourmaline have? Well, they have all this land, but all these lands have like 10 zones in them, which they can produce from. So that's where the 75 years of drilling inventory comes in, because you just look at the land and you say, no, there can't be 75 years here, but it's because they've got 10 zones in, not throughout the land, but they've got more than one zone everywhere, and they've got 4, 5, 6 zones in many places. So it does change things a lot, having these multiple zones. So keep that in mind. The Wapiti Cardium, I like to bring this up because this is the land I used to work for Modern Resources before Tourmaline bought us out, 67-8. And Tourmaline is drilling really, really good wells in the Wapiti Cardium. I don't know what they've changed, whether it's the frac, whether it's the drilling itself, but something's changed, and they're drilling really, really good wells. These 15 to 32 Cardiums are basically the top Cardium wells in the last 12 months. They're pretty good wells. And this is their little oil play. They've got 2 or 3 oil plays, Gundy, Charlie Lake, obviously, Wapiti. So keep an eye out for these oil plays. If they're able to drill better than type curve wells on the oil plays, increase production another, whatever, 10,000 barrels per day, it does make a difference. At the end of the day, it does end up making a difference. So just things I track again. And what do they have in their inventory? We have internal rates of return more than 200% on these 6 assets, some over 1,000% rates of return at $3.50 gas price, AECO gas price. Yeah, AECO gas is currently at $7 plus. So I'll let you run the math on that. It's phenomenal. These gas wells are just crazy payouts at $8, and they've got 75 years of inventory. It must be hard to be management at Tourmaline and not just go crazy drilling right now. Like, just take every rig out there, take every frac fleet, and just go crazy, because they could grow to 3-4 BCF in no time. It would not take them long. Supply chain is an issue. Obviously, permits are an issue in Northeast BC, but they're maintaining capital discipline, and I got to give them kudos for that, because they've obviously realized that they can make way more money by just staying still and getting $8 for the molecule than to get 350 and have more production. Operating costs, that's what you like to see. For a company that's growing and costs are getting higher and higher, they've done really well keeping their operating costs in check. G&A, I've spoken here. There's a producer that I'm invested in, ARC Resources, who had excessive G&A cost here on their Q1 report. This is what I like to see on G&A cost, going down, and then it flatlines at a certain place. It flatlines. I don't want to see this spike when gas prices are high, when they're making money. You don't want to see this randomly spike and they're paying out way more in share compensation and warrants and options. It's happened. It's happened in 2010 to 2014. These companies, they do like rewarding themselves when times are good, and they had nothing to do with it. It's just that the pricing is higher. So good governance is becoming more and more important to me. I know if you look at my seminar from 6 months ago, I would have said that I don't care about good managements because I want the poor managements where the share prices have a higher chance to appreciate. And I'm definitely changing my tone now. Governance is getting more and more important to me and my investments as we go. 6 months ago, you couldn't convince me to buy Whitecap 6 months ago. There's no way. Now it's a name I really, really like. So keep that in mind, this G&A. Companies that don't have good G&A will not give you a slide deck like this. So might have to go looking for it. Okay, a couple other things on scale. Tourmaline, with their scale, they get pricing exposure. They get exposure to the LNG pricing. Station 2, which is down in BC somewhere. Dawn, Chicago. PG&E Mullen, California. NYMEX, Chicago, Texas, ACO, US Midwest. They got exposure everywhere, which is where you want to be, because you don't want to suffer from pricing blowouts in certain big differential blowouts in certain parts of the world, certain parts of North America. They also get exposure to pricing, which people don't realize, that natural gas pricing in California, which is, I'm pretty sure PG&E and Mullen is down there, is a lot higher than the rest of the American market. Pricing in the US East Coast by New England, Boston area is a lot different than NYMEX pricing. And having exposure to that, it's just extra money in the bank. That's all it is. So, yeah. So what else we have? Top gas producing other formation wells. Tourmaline is on the list a lot. Monthly gas production, doing really well, drilling really, really good wells. We talk about the stacked pay. They've got some in the Notikewin, some in the Wilrich, some in Falher. We go back to this here, Notikewin, Falher, Wilrich. That's what I mean by the stacked pay. You can get a bunch of gas out of this zone and then drill into this zone and then this zone. That means you have way more inventory than what your land map is going to show. Oil producing wells, Charlie Lake. We talked about Tamarack. It's the exact same chart that was in the last Tamarack page. But we see Tamarack's got 4 of the top 9, but Tourmaline's got 2 of the top 3 wells in the Charlie Lake. So they're doing really well in Charlie Lake as well. And it's just a great formation. And Tourmaline's got tons of land in the Charlie Lake. I don't know if we can see it here, right here. They've got a ton of land in the Charlie Lake as well. So Tourmaline not only has the gas exposure, they're growing their oil plays in Gundy, Charlie Lake, and the Wapiti. Sounds pretty great. Okay, so the questions here. So if you extend these charts back to 2005, I don't have that, but if someone does, I'd be happy to see it for sure. As long as we can supply into an exporting market, we can get indirect LNG access. Yeah, that's right. And the pricing power with it, and the floor pricing with it, which is great. Tourmaline, in addition to the portfolio, I can't buy Tourmaline just because I've worked there. It's just, I don't want to have any conflicts of interest, especially with how public I am about sharing information and sharing my portfolio. So I've avoided buying it. And I still don't like companies that are like 70, 80% gas. I like the condensate plays more, and Tourmaline just doesn't have enough exposure, despite their Charlie Lake, Gundy, Wapiti. 20% oil is a little bit lower weighting, is lower than I would want, I should say. I did a seminar on NuVista here last week or last month, I want to say. So please check that out, Vic. I share much more there, and we actually go through the valuation. So check that out. How do you compare Tourmaline to ARC Resources? I like ARC because of the condensate exposure. The oil exposure is what really gets me. The 40% oil weightage, or I can't even remember what the number is right now, but 35, 40% oil. Companies I thought, and I still think, are going to be set up better into the future. But with gas prices at $7, things definitely can change, and I might have to adjust accordingly if the gas prices become more and more stable at this range, especially if European gas keeps going higher. That pull on LNG is just going to be nonstop. So, yeah. Okay, so what is going on with LNG Canada? So LNG Canada phase 1, I believe, is roughly 2 BCF a day, somewhere between 1.5 and 2 BCF per day is what we need extra once that started in early 2025, let's say. Best case, middle case. So 3 years, we need another 2 BCF. Canadian gas inventories are at their lowest pretty much ever. Canadian gas production is at its highest ever. So how can that be? Well, because Canadian demand is just through the roof. And there's another, I want to say roughly 1 BCF of coal to gas switching going on in Alberta itself. So they're shutting down the coal plants and they're converting them to natural gas plants. So we need about 3 BCF in 3 years. It's going to be tough. It's going to be very tough, especially with the supply chain issues, with the permitting issues, with companies not wanting to expand, with the prices so high. It's like still companies are like, no, we're fine. We'll just keep minting cash and stay there. So watch what's going to happen. Who's going to be the one who's going to grow? Is it going to be a Shell? Is it going to be a Petronas that comes out of left field and starts drilling and growing? Because it's very competitive against their other world projects. Hard to say, but the reality is we need about a BCF a day extra for the next 3 years, along with other demand increases to Eastern Canada, to the States. So yeah, it's not a bad place to be in Canadian gas right now. It's pretty fantastic, as we know, obviously. Thoughts on ARC Resources and their hedging losses? Yeah, I just can't say much. I'm pretty frustrated with that holding. I will be honest. And if they continue to hedge more and more into 2023, yeah, Cenovus had their strike 3 and they were out. And ARC Resources is, yeah, maybe on strike 1.5, strike 2 here. So yeah. Methane demand, yeah, for fertilizers, and US industrial demand, yeah. Yeah, the US is natural gas demand is through the roof as well, along with all the exports into Mexico and the exports from LNG. So the natural gas market is tight globally, like very, very tight. And that's with Russia pumping all the gas that they can, or that they want to right now. If anything happens there, yeah, it's gonna be interesting. Okay, so yeah. You see Canadian gas heading to LNG? Yeah, so ARC Resources just made a deal, 140 MMCF per day. Tourmaline, I believe, already has deals. So I think so. I think they'll make more deals as they go here, which is great because it's a long-term contract with, we know they're going to take the gas. It's basically a take or pay, which is sweet. Yeah, more clarity, more line of sight as to what's going on. So France has problems on their nuclear plants. So power gen is off when these come back online. Yeah, I mean, I'm not saying I'm going to be right on European natural gas. I'm just saying I'm going to be betting that way, and that having effects across the North American gas market. Europe used way more coal in 2021 than they did in 2020 or ever for the last 3 or 4 or 5 years. So people go to the cheapest source of energy. And if natural gas is going to stay high, will the nuclear get turned back on? Will the coal get turned back on? I think Europe is so dead set on shooting themselves in the foot, like with a shotgun, that it's gonna be tough for them to say that they screwed up and they're gonna go back to coal and go back to nuclear. Ego, the human ego and the human nature might delay that longer than we think. It's not strictly economics, but again, I'm not gonna say that your view is wrong. I'm just saying I invest based on what my view is, and people should be investing based on what their view is, for sure. Not what I think. Strike three for Cenovus was the hedging loss in Q1 when they reported that they've lost all this money on hedging, which I knew they were doing some sort of like hedging front month. Not really hedging, but just hedging the front month. But yeah, it just turned me off. And you know what the sad thing is they're going to make so much money on refining margins, Cenovus, and so much money. And with hedging coming off in Q2 and Q3, that stock probably ends up doing really, really well. But it's the way she goes. It's the way she goes. I can't be flip-flopping around based on what happens. I can find other companies with refining exposure and get better management possibly and more upside. So yeah. Okay. Wow, there's a lot of questions. So yeah, so I'll go through a few of these questions and then I'll go into the PetroNinja Wells update, and then I'll open it up to the open Q&A, which it sounds like we might have got into it already. But yeah, so do you think they will stop LNG from the US for political reasons? They can try, but what are they going to say? Ban LNG after companies have spent billions of dollars on building these terminals, after the producers or the exporters know they can make billions more by selling in Europe instead of the US? Yeah, sounds a bit like anti-America almost in a way. And people have been talking about oil export bans for a long, long time. It hasn't happened. I don't think the LNG export ban happens. Yeah, it's going to screw up. It's going to screw up the system because if the LNG export ban happens, American natural gas price is just going to collapse. Like without the LNG exports, we're going to be seeing like 300, 400 BCF builds all summer. That's not what they want either, because the supply is going to get screwed up. And maybe the government doesn't think, but I don't think we're going to see an export ban for LNG. What are your thoughts on AltaGas? I don't follow the midstream companies. Sorry, I just don't see the upside in them, along with the royalties. On natural gas, yeah, everyone seems to assume that Russian gas will just keep flowing. I was reading something the other day that Latvia stopped buying gas from Russia because it was too high. What if gas prices stay high all summer? They go into next winter with low inventories, and it's a cold winter. Latvia supplies gas not just for Latvia, but for 3 or 4 countries within the region and northwestern Russia itself. So what can prices go to? That's my thinking is, okay, yeah, we'll fire up the coal plants, we can fire up this and fire up that, but all Russia has to do is one thing. And we're in a completely different environment. And then I do think there's a non-zero chance of that happening. So, which is why I invest accordingly. Yeah, if I was to sell ARC, where would you allocate? I don't know right now. I'm going to do my Q1 valuations and go off of that. I did add to not add, I started a position in Obsidian on Friday. So that's where I see a lot of torque right now, at a very good valuation. It's just amazing how it can sell. It can sell at $10 a share in February, and it's still selling at $9.50 a share in May. Doesn't quite make sense. Same with Tamarack Valley. It's the exact same. I have almost the exact same reasoning for both. Yeah, I had to sit on Surge for 6 months before it did anything, and now Surge is the highest performer year to date. You can't time them, but I buy the good companies with solid cash flow that have been lagging, with great assets and great well performance, and they've really all worked out. There hasn't been any that I've really been caught on so far, but fingers crossed. And that's why I spend so much time on doing these valuations. What are your thoughts on take gas prices down? I don't think anything can really bring gas prices down. Yeah, even if LNG slows down to Europe, it's got to go to Asia. So American LNG was going 70% to Asia before last year. It was 30% to Asia. Pakistan doesn't have any LNG. So they're reverting back to using fuel oil. There's a market for natural gas, even if Europe stops buying. And I don't think Europe stops buying. Please share thoughts on OVV. Yeah, Ovintiv is a great company too. Ovintiv's got the best natural gas wells in Canada by far. Like this RBC list, the top 15 in the Montney, Ovintiv has all 15 in their heritage play. I just don't like the company, the way it's run, their excessive hedging, the way the management just has dealt with the whole Canadian issue. Yeah, it's just strange. Yeah, okay, so let's move on to PetroNinja here, and then we can do the Q&A for those who would like to stay for that. Okay, so the PetroNinja wells update, I mentioned that I'm focusing more on the wells now. There's certain wells with certain companies that I'm looking for, not just the well. I don't care about the well itself and what it's making. It's about, if the well pans out, it tells me that the company's other wells in that acreage have a good potential of panning out. It gives me confidence in their future production, in their capital plans, in their growth plans, in their decline rates, capital efficiencies. It gives me more clarity around that. So I've been tracking a few wells, and how do I get to? I track a lot of wells, but I spent most of my time tracking wells that are in the companies within my portfolio, naturally, because if I'm already invested in them, I'm more concerned about what's happening with these acreages. So the wells I'm going to share today are maybe 1/10 of the wells that I'm not actively tracking, but passively tracking. However, these are the ones that matter most to me. It's in the companies you'll see that are in my portfolio. And I don't want this to be that people are just relying on me to do all this. It's about, if somebody wants to learn PetroNinja, you want to track your own wells, you want to learn more about which are the emerging plays, what's going on. I find PetroNinja fascinating. Any software that shows well production, shows the acreage, the land holdings. You know, a lot of people may not care for it, but for anyone that's doing their valuation models, you're actually putting in, you want to do your own due diligence, you want to do your own work, you have the time, you're interested enough to do it. This is the next step that I've been taking, and trying to share more of this. So Spartan Delta. Yeah, okay. So Spartan Delta, I've talked about this 6402 area before. It's got a natural fracture where the Montney A and B, or whatever you want to call them, the drain into the Montney C. So all you need to do is drill in the Montney C, and your decline rates are just phenomenal, because as your Montney C declines, the Montney B and A drain into that pool, and you keep producing oil for many, many months and even years without having to drill new wells. So this is a well I really track, because I don't know how wide the natural fracture is, But Spartan Delta has a lot of land in this area. It's near the Simonette, just north of the Simonette is where we are here. East of the Kakwa, east of Arc Resources is where we are. And it's really important for me to track this well and see how its decline is going in its later stage. So we see the well had almost no decline in year one. And again, I've been talking about that before, that Spartan has these lands with zero decline in year one, compared to other Montney wells are up to 70% decline in year one. In 3 years, Montney wells decline 90%. Spartan has roughly a 50% decline after 3 years, which is roughly where we're at here. This well came online in July 2019, roughly. And production has gone from, it's a log scale, production has gone from 600-700 barrels a day. Green is oil, red is gas, blue is water, has gone to 400, 300, so 50% decline. We see the gas oil ratio on top here is relatively constant, which is what I like to see. If we look at Permian wells and Bakken wells, the gas oil ratio is just skyrocketing in these wells, which tells me the asset quality is degrading, the well quality is degrading, the reservoir properties are shifting to the bubble point death, as they call it. Whereas here, I don't see it so far, so happy about that. The orange is a runtime. Good operators will have 100% runtime or close to it. So, you know, it's not just the production, it's about noticing things about the company. The next well, this is a newer well, right next to the one we just discussed, which was here. This is a well that came online, drilled by Velvet before the acquisition, somewhere around there. It's even better. If we look at the last well, it came on at 600 barrels a day. This one's 800-900 barrels a day. The newer wells, they are the same wells, but have more proppant, I believe. They've jammed more frac fluid, and they've increased the spacing on the well as well, which I don't want to get too technical, but there are changes being made based on compared to what Velvet did in the 6402 area. So we're getting better wells. Again, almost no decline. It's been 8 months, 6 to 8 months. Gas oil ratio is going up a bit, so something to watch for on this one. Not complaining with AECO at $8, but still something to watch for because it's a condensate that's a real moneymaker at the end of the day. Runtime again 100%, so looking great. There's a comment here. Every company claims you have low decline rates. How do we know if their claims are correct? There's no easy way to tell if their claims are correct, but what I look at is capital efficiency. So if they have 20,000 barrels and they want to keep production flat for next year, how much money are they spending? Are they spending $100 million? Okay. What is company B spending? If company B is also 20,000 barrels a day and they claim their decline rate is the same as company A, but they're spending $250 million to keep production flat, they're lying right to your face as to what they're doing. That's how I can kind of compare companies. So pick 5 companies with the same production, roughly the same gas oil split, and see what they tell you for decline rates and see if it makes sense with how much money they're spending to keep capital flat. And if there's an outlier in there, better call the management, see what's going on, and if there's an explanation for it. If there isn't, yeah, probably avoid the company. Whitecap. So these are the 2 Spartan Delta wells we just talked about with the natural fracture. This is about 4 or 5 kilometers away from that, maybe 7 kilometers. There's no natural fracture. It's on its usual decline rate. In 1 year, it's declined 50%. Less than 1 year, it's declined 50-55%. So we know the natural fracture is here. Well, in all 5 actually. As soon as we get to Whitecap's acreage, it's gone. So again, does Whitecap have lands here? Can they come closer to the natural fracture? Can they maybe drill some delineation wells closer? How much acreage like this does Spartan Delta have? I don't have those answers for you yet, but doing this kind of well by well analysis tells you, if I check these other Montney wells, I could probably get a rough area where the fracture for sure isn't there and where the natural fracture for sure is there. Is that going to tell me really anything? It's hard to say until I know how many wells I have to look for and what do they show me. But I do, like I said at the beginning of this presentation, I've been really enjoying these due diligence reports. So I hope to have one out on this acreage specifically, and where, how much more wells does Spartan Delta have here in the future. Arc Resources, not far from the last 3 wells I just showed you. These are nice wells. This is condensate here. This well just came on and producing over 1,000 barrels of condensate. Arc Resources has really, really good wells. The 7 gens Kakwa they bought is a top tier prolific asset. We can't argue that. The well results speak for themselves. Like, these new wells are really, really good. And I talked about the tighter spacing, or the wider spacing that Spartan Delta is doing. So look at Arc Resources wells, how many wells they've jammed into this small area, and look at Spartan Delta's wells. Which one is better? There's no right answer. The tighter your wells, the more of the reservoir you access, but the wells are worse off individually because they're interfering with each other. The declines are going to be higher. Whereas you drill these wells, you access less of the acreage, but the single well economics are way better, and the decline rates usually end up materially better with the wider spacing. Arc Resources in the Ante Creek area. So this is their legacy stuff before they got into the Kakwa, the other Montney. Pretty good wells. Like these are 900 barrel day wells are pretty good, and they've got lots of acreage, I believe, still in Ante Creek. But we'll be watching closely, see how these do, see what the declines on them are. That's what I'm most interested on. The gas oil ratios are much higher. For anyone that's on the Twitter that wants to see these visuals, the Zoom link is on the website, whitetundra.ca. Scroll to the bottom under events, there's a Zoom link. If not, and you're just listening in, that's fine. There'll be a recording as well, posted in the next couple of hours. But really, with the well results, I think it's important to see them as opposed to just listening, but to each their own, and it will be posted later as well. So surge, let's get to surge. So we had a seminar in September or October-ish, maybe November it was. We talked about Surge's new multi-leg Sparky play. Raymond James put out a report. Jeremy McRae had a report on the Sparky multi-leg with the oil-based drilling mud, which I've been very, very highly optimistic on. So let's do an update on those wells. They had 3 wells, 1, 2, 3, and this is a new well that they just drilled. So I don't have production on that, but I do have production on these 3. So, you know, pretty decent. Like 6 months down the road, it's still producing 100 barrels a day, which is pretty solid for a well that only costs $1.2 million. And you don't need casing, you don't need frac, you don't need fresh water. It's not exposed to inflation really. That's a pretty good well. And when we were on the Tamarack Valley part, I talked about the water flooding potential of Tamarack Valley. This is without water flood. So of course we're going to see declines without water flood. If we can make if Surge can find a way to make water flooding work, they could do the same thing that Tamarack just did, and the upside on Tamarack, except where any investor in Surge is front running that about 6 months or 1 year before that happens. That's exactly where I want to be. I want to be in companies where there's a future potential there, that the market doesn't realize that Surge could possibly water flood these and maintain production for a long, long time because they have so much exposure of surface area in the reservoir with these multi-leg horizontals. So you'll produce oil for a long, long time if they have pressure support. The second well, pretty decent. It's fallen below 100 barrels a day, so something to watch for. Maybe this is the one that gets the water flooding trial first. and check it out. But we'll see. The third well, it's not a good well, really. If we look at the first two wells, gas oil ratio is around 1,000. Great. For heavy oil, you want less gas, a lot less gas, because a lot of the pump jacks and pumps have trouble pumping the gas with the oil. They seize up and all kinds of issues. The third well, the gas oil ratio is three times the other wells. So they're definitely struggling a bit with keeping production going. Around 50, 60 barrels a day is where it seems to have leveled out, which isn't bad. I bet you this well is still paid out in less than 6 months, 8 months, whatever it's been. But again, when we're delineating an area, we want to hit bangers all the way. We want to be hitting good wells, and I'm excited to see how this well does with the learnings they had from the first three. And maybe this is the better area to drill in. Maybe this well that's higher gas oil ratio is not the place to be. So the fact that I'm seeing them drilling another well right now in this area where they hit the two better wells gives me confidence in management that, okay, they realize what's going on. They think these wells are good enough already to warrant the next drill. And that's exactly where we are. Our short time, there's a question here, are short-term production decline rates subject to manipulation? You can, yeah. You can screw up your drilling rate and claim it's something by just shutting off your high production wells, I guess. But on an overall basis, if you look at the rolling capital program to keep production flat, it'll give you a pretty good idea of the capital efficiency, which is really what matters over a longer term time frame. What's going on in that 4 square? So no one has drilled there so far. That's really all that's going on. This picture here is 1 mile by 1 mile. This 16 boxes are 1 mile by 1 mile. So it's a pretty small area we're looking at here. So just that nobody has drilled here so far, but maybe Surge start drilling the next one here or here. We'll find out. Surge and the Frobisher in the southeast Saskatchewan, they bought 2 companies, Astra Oil and Far Sky. The market absolutely railed them all last year for buying these. And now they've got the best wells, some of the best wells in North America in the Frobisher with 10, 15, 20 years of inventory. It's the way it usually goes. People read headlines, people don't do the work. They just, this guy's that, and the wells are this, and they paid this and they paid that. The Frobisher, in my opinion, is a place to be. If I was buying oil wells, I would be buying land and drilling opportunities in the Frobisher or the multi-leg horizontals. Surge has both. So Lampman, Frobisher wells, cheap. You can drill these for $900,000. They pay out in 45 to 50 days. Some of the best wells pay out in 25 to 30 days. That's a fact. Do they decline harder? Yes, they do decline pretty hard compared to the multilaterals. But when you can pay off a well 5 times in the first 6 to 9 months, yeah, all day long. Like we're drilling those all day long. So Surge is drilling some monsters here, like 400, 500 barrel a day Frobisher wells in the first month really. Just fantastic. The gas oil ratios are good. Runtime, as the well is going into its full production phase, the runtime is looking great. Okay, a couple questions here. I don't know the facility where Surge had the fire damage. No, I don't. But I'm sure if you contact management, they can tell you. But it doesn't really matter to me. Like fires do happen in oil and gas facilities. It's not uncommon. Like it's rare, but it does happen. So yeah. Still not sure if the Whitecap wells compare to the other companies' well you're showing. Okay, let me talk about that so it's clear. Is it true that Spartan Delta management is not shareholder friendly? They've been shareholder friendly to me. That's a company that I'm not looking for a dividend from Spartan Delta. I don't really care. When they're drilling wells like they are in the Montney, they can continue their 10% growth rate. I want them to make acquisitions with that money, not dividends. Like they can make way more money in the Montney than I can with getting that money back to me. So keep in mind which companies you're investing in and why. Not every company is on board with the 100% free cash flow to shareholders plan. And I don't expect them to be, because it just depends what you're investing in. So let me just go back here and explain this a little bit better. So Spartan Delta's wells in the 6402, they're in the natural fracture, so they don't decline. And they're way better wells, way better economics. Whitecap in this area specifically is outside the zone on this well. I don't have a map showing Whitecap's lands. Whitecap could have lands here closer to where the better producing wells are, is what I'm trying to show here. So I don't know that. I know Spartan Delta is already in there, which is why it's in my portfolio. But Whitecap, I'm still waiting. Whitecap has way better fields other places too. So we can't just look at this and say Whitecap's well sucks, because Whitecap has many assets, whereas Spartan Delta is basically the Montney and the Deep Basin. Okay, so doing very good in Lampin. What other companies are working in Lampin? I honestly don't know. I think these are all surge wells, but Whitecap, I know, has some acres there. Vital Oil, there's a company, Vital Oil, they're drilling in Lampin, but they don't have any land left. So you want to buy companies. I want to buy companies that are drilling good wells and have land there. They need to have future drilling potential to take advantage of these great wells. So that's also what I look for. Another one in Lampman, a Frobisher, absolutely fantastic. This well, I bet you paid out in 35, 40 days, like just phenomenal. Production out of a well that only cost less than $1 million and making 500 barrels a day. So making 500 barrels a day for the month, that's 15,000 barrels. The netbacks are probably $60, $70 a barrel. 15,000 barrels at $70 or at $70 a barrel. There's your $1 million right there in 1 month. And it doesn't look like March was any worse. It seems to have made another $1 million in March. Those $70 netbacks were at, I believe, $90 WTI. Low royalties, I believe, in the Southeast Saskatchewan as well. So just great. Another Frobisher well, a little bit further down its development cycle, you can kind of see the decline on it, but 6 months down the road, still making 250 barrels. That's $500,000 a month for something that cost $1 million to drill and get onto production. Both Astra and Far Sky and the recent Surge Steelman acquisition are all for the Frobisher, Frobishers/Midale for the most part. This is Surge in the Sparky. So they drill multilateral wells in the Sparky, but they're also drilling these single leg horizontal wells in the Sparky fracked. About $1.2 million roughly, and lower decline. It's less production than the multilaterals, but it's a lower decline. And I believe these can also be water flooded much easier. So you maintain this 80, 100 barrels a day for a long, long time. So I'm tracking Southeast Saskatchewan and then the Sparky for Surge. This is Surge's Valhalla up in Grand Prairie, kind of by Charlie Lake lands. They don't spend much time here. They don't spend much money here drilling, but pretty good wells. Like these are pretty damn good wells coming on at 600 barrels a day, still producing 100 barrels a day in a year almost. That's, or not 100, but yeah, 250, 300 barrels a day roughly. 9 months to 12 months after they got put on production. That's pretty good. So people have been asking about Surge asset sales. Keep an eye out on the Valhalla acreage. It's not core to them and pretty good acreage. It's not just some junk that's out there. Okay. Whitecap in the Cardium. I believe this is the Cardium, yeah. Phenomenal. just absolutely knocking it out of the park. Like this is for a Cardium well coming on at 800 barrels a day, 750, 800 barrels a day. Crazy. Declining, not bad, not a bad decline rate. It's been 6 months, more than 6 months. So not too bad, but Whitecap has lots of land in the Cardium. They've got lots of assets, facilities, production. They can do well with this asset and growing it. You see a lot of companies are suddenly talking about growth in the Cardium because Cardium can grow. They have the land, they have the facilities, they have the acreage, and Whitecap can do a lot here. What is this here? Whitecap Charlie Lake. So we talked about Tamarack's Charlie Lake. We talked about Tourmaline's Charlie Lake. Whitecap's Charlie Lake is pretty good in its own regard. Over 1,000 barrels a day, IP 90, let's say IP 60. Hard, heavy decline, as is with most Charlie Lake, Montney wells. But probably still got really good payouts on this. Less than 6 months, I would bet. And the rest is all free cash. And it'll stay at this 200, 300 barrels a day for a while. And then it'll go down to 100 barrels a day and stay there for a while. So, you know, they usually put these wells on gas lift, and then they can sustain production for quite a while. Whitecaps, Frobishers. So we talked about Sturgis Frobishers. These are Whitecaps, Frobishers. Pretty decent wells, 300-400 barrels a day. But acreage inventory issue, possibly. You know, you see what I mean about, do they have good wells, but can they actually keep drilling those good wells? Do they have the land? Do they have the acreage? Possibly less, a little bit less than Surge. Does PetroNinja tell us how the well is operating? That is using that efficiency method with water. Yes, so PetroNinja does tell you how much water was injected and how much water is being produced. Right here is the water production. So when the well goes under active water flood, you'll see the water production climb up to like a 90% range or 80% of the well's production. Right now, it's only 25% or less. So yeah, great question. What do we have here? More Spartan Delta wells in the non-natural fracture zone, coming on at 600-700 barrels a day. Byzantin, really good. This is Gordondale. Another one of Spartan Delta's acreage. You see how it's not as good. It only came on at 300-400 barrels a day, 500, and started declining. Whereas the ones in the more of the Byzantin Carr area, south of Grand Prairie, south of Grand Prairie are a little bit better. They're definitely better than the Gordondale acreage. So where do I want them spending money? If I want to see their 2022 capital allocation, it should be in Carr. It should be in Byzantin. They should not be greatly expanding the Gordondale area other than for delineation purposes. But again, just things that should make sense, right? If the company has better wells in one area and they've got a ton of acreage, that's where they should be spending money. If they're not, it's in our fair right to question management and what's going on. Like, are you delineating it? Are you looking to sell it? Have you found something? Did you screw up the well that you drilled, right? Find out what's going on. Another Spartan Delta well in the Montney, the regular Montney, non-Gordondale. You see how it's way better? It came on at 800-900 barrels a day. It's still producing 500. It's 6 months later. Gordondale, it barely started at 500 and it's already down to 300 in 3 months. Dark Warrior, this is a well that's right next to the new Westcan drill. The Westcan Energy drill is going to be in box 27, somewhere around here anyway. And for more information on why I'm talking about this well, check out the Westcan Energy deep dive and the Razor Energy deep dive. But this well is not doing very good. They've definitely hit the gas zone. When I talked about the Westcan Energy land, I said, well, I think one of the biggest concerns and possibly the only concern to me is this underlying gas zone that's present in this Manville area here. And the oil hasn't panned out. First of all, they're completely out of the zone to begin with. So the oil hasn't panned out and the gas has come on like crazy at 12,000 is the ratio, which is just not good for an oil well. They screwed up, and I'll defer to Rock Creek Freak, who's on there, who's also on Twitter. He has some really good insight as to why they hit gas. Their drilling just sucked. Like, they were in and out of the zone. They were missing the formation. It was just a bad drill, and we can tell. The oil sucks, the gas is way too high, and they're flaring all the gas. What does that tell me? That tells me they never expected this sort of gas production, because if they did, they would have made arrangements to process it and actually at least sell it and get money off it. But instead, they're flaring everything and they're making no oil. An absolute trash drill, but it's the way she goes sometimes. And following this well very closely. Very Provident. This is a new holding of mine. They're drilling these glauconite wells in Princess, and it's basically their only growth play, if you will. The rest is water flooding and small wells, but the Glock is a growth play. Pretty cheap wells, somewhere between $2 to $3 million, I want to say. Yeah, if I'm not wrong. Coming on at 600 barrels per day. 3 months later, still producing 300. Not too bad. Those will have 6-month payouts, 6 to 9 month payouts on them. But how do I know what's going to happen here? I look at an older Prairie Provident Glock well. We can see I can calculate the exact decline rate for this well for year 1, year 2, year 3, and year 4. So for anyone looking to, you have a holding that's smaller, 5,000 BOEs a day, 3,000 BOEs a day. This well is 20% of their production. Or for Prairie Provident, it's just over 10, 15% of the production. I need to know how this well is going to perform in the future. So what do? I look at an older Glock well. I can calculate some sort of decline rate on this. I can see how they've panned out. And it gives me more confidence in these newer wells, where it's 1 or 2 or 5 wells that can make or break a company. It gives me more confidence if I have older wells in the area that have performed really well, and I can use them as a proxy, as opposed to relying on management's type curves and estimates, which may or may not be accurate. We don't know. Trust no one. Spur in the Clearwater, the best Clearwater operator out there. Drilling monster wells in the Clearwater. So as a company, where do you want to be? You want to be right next to Clearwater, because the lands have been delineated. Something about the water flood. There's more 3D seismic. There's more information about the well's decline rates into the future. They've tried 6-leg horizontals, 8-leg horizontals, 14-leg horizontals. There's a lot more data to work with. Tamarack Valley is right next to Spur. Not much else to say there. So yeah, so that's a few of the wells that I'm tracking, a few of the wells that I'm kind of focusing on, looking at new play development, looking at water floods, multi-leg horizontals, Southeast Saskatchewan, focusing on what's going on, trying to figure things out. And my goal always is to front run any production beats. So I should be finding out about these production beats before the company posts them on the market, before they make it obviously clear, and then the share prices ramp up on it. Because I think there's a way to do it. It doesn't take too much time, and it's worth the time spent to find out about these exceptional wells, exceptional acreage, and asset quality before they have to spell it out for you, or spell it out for investors in their Q1 results or in their corporate updates, at which point the price is going to go up 10, 15, 20, 40%. When Baytex first released their P-Vine results on the Clearwater, on just 4 wells, the market cap went up $1 billion. So more than $2 a share, which at that time was like 100% increase or somewhere around there on just 4 wells. And, it's worth spending the time, in my opinion, and following these wells and seeing what's going on. I don't have any on Headwater that I track. In fact, I probably will never end up tracking any Headwater wells, just because the company trades at such a premium that even if they had killer monster wells, I just can't see myself investing in them. at the valuations they trade at. The stock price could be a third of what it is, and maybe get a person interested, but it definitely gets a lot of value for their management and good governance structure and growth. So yeah, I guess I'll open up the floor to Q&A for a few minutes if there's anything. If not, we'll end the recording and get it posted on YouTube. Next week, I don't have anything coming up, but May 21st, I have Advantage, Crew, and yeah, I can't remember now, but I got three Montney players, Advantage, Crew, and one more coming up. And yeah, May 28th will be my due diligence. I got 2 companies in mind that I'm going to do a deeper due diligence on, kind of like the Razor and Westcan session, and kind of share exactly what I'm seeing on them. And doesn't mean that I'm invested in them, but I've done the time doing the due diligence. So just sharing the process. And yeah, Kelt is the other one. Thank you. And then we'll begin in June with some other stuff that I got out there. I'm moving into my new apartment in 2 weeks and should have way more time after that to actually put out the content that I've been wanting to put out for a while now, with the price targets and the intelligence suite and the deep dives, the due diligence, et cetera, and kind of go from there. That's right, the Slido questions. Can anyone help me here? How do I access those questions? Is there a link here? Thoughts on Crescent Point? Too much hedging, too conservative. Drilling great wells, one of the best engineering teams out there, the best geology teams out there, but it's not run by oil people. It's run by people who are technically very strong. They don't understand the macro at all. They keep hedging. So I do think they're lining up for an acquisition. They did sell what did they sell? There was a sale they just made that they haven't reported to Paramount. So there is a sale that was made, I'm guessing about $150 million roughly. So it seems like they're accumulating cash to buy more in the Kaybob, Duvernay, or expand. But yeah, we'll see. Yeah, no, so on Enerplus, I'm bearish on anything in the Bakken. And for reasons why, please have a look at the macro from last week. The Bakken is a mature, dying reservoir with bubble point depth, gas oil ratios going way up, tier 3, tier 4 wells. Can Enerplus find more gravy zones that have been bypassed? Potentially, but I just not interested in taking that risk, the exploration risk on that. Thank you. Okay, so I'll open up the Slido link. That's cool, yeah. And okay, you mentioned you might take a position in PetroTal. Yeah, so I'm actually very interested in PetroTal, but the more people I've been talking to, the more they tell me that the social unrest issue is going to get worse, not better. It's just the way society is there. It's just the way it's set up, and I really like the valuation on PetroTal, but if they're only going to be able to produce half of what they should be producing, your valuation changes dramatically, right? So yeah. Okay. No, Spartan, I did not trim any Spartan Delta. It's just the weighting might have gone down with the addition of Tamarack Valley and the movement in Surge and Meg. Yeah, plus I did add some new capital as well in there. So yeah, Spartan Delta was not sold for sure. There will be no shares of Spartan Delta being sold for a while, as far as I see this playing out, especially with now gas price so high. And Spartan Delta, 60% of their production is gas, 65%, that the market just doesn't care about, but they will care about when the free cash flow numbers come out. Athabasca had record free cash flow. Yeah. The worst management there could be out there. I'm not even going to hold back. Athabasca as a company could be one of the best companies out there, making a killing in free cash flow, but just so poorly managed. Yeah, it's just too bad because that should be a $7, $8, $10 share, but I don't even look at it because I know something's gonna get screwed up. They're gonna mess up the drilling, or the Leesmer or Hangingstone. Something's gonna happen there. Yeah, lose money in warrants and rights and the dilution. It's just, yeah, crazy. Paramount bought the Duvernay. Oh, only 40 million. Wow, they got a smoking deal if that's the case. Yeah, unreal. Because that was like 1,500 barrels a day. No, we have 15 to 2,500 BOEs a day for only 40 million. Yeah, strange. Okay. So we'll get to this. Nice. Okay, right on. So, okay, I'll go from the oldest to the most recent. Yeah, 1,300 BOEs. Okay. So did they keep some of the Duvernay, like some sections? Because yeah, as far as I remember, when the teaser came out, it was way more than 1,300, or they just let it decline. Okay, so what else we have here? So what is your reasoning for selling Whitecap? Like I said, I bought a whole bunch of calls, way more contracts than I ever have. Like, yeah, it's amazing how many contracts I have. Like I would probably say much more exposure there than anything in the past. So yeah, so I'm just leaving it for now, and I'll see what happens. Sold the equity because it just wasn't a huge position. I didn't have many shares and it was just hanging around. So, I'd rather play it with the contracts if I already have them. For sure, yeah. Any regrets of selling Cenovus? Yeah, for sure. There's always regrets for selling a name and it goes up 25, 30%. But you know what? It's just a matter of just how things go. I still made a lot of money on Cenovus, including the options actually ended up working out really well for me. But it's a refining. Their refining is making them and gonna make them a ton of cash going forward. And that's the part I more regret than regretting the actual management or what they've done. Because I'll tell you what, Cenovus 3x their dividend and it's still less than what Whitecap already has. So it's not like they did anything crazy and they're leading the pack by any means. They're the lagger in the pack in terms of the news coming out and the headlines coming out. So I don't regret it really. And if I can get an exposure to a different refiner, it all works out in the wash. I'm not really concerned. Can you talk about Prairie Provident, why you like it? Sure. So this is a recent addition to my portfolio. I wasn't really a fan of this name with the hedging and just the way the company set up was a little strange. And I came upon two or three things that I really noticed. One, their 2023 hedges don't have any upside ceiling on them. So come January 1st, 2023, they go from being 65% hedged at $60 oil to unhedged, basically unhedged on the oil. They have the two-way collars and the put options and all that to appease their debt holders, but they don't have any upside on them, upside ceiling on them. So, okay, like I said, I like to get into these companies where the hedges are dropping off. We're already in May. We're already almost in mid-May. So 5 months into the year already. January 1st, 2023 is not far off. The other thing is they have about 40% of their production, I believe, is gas. Gas went from selling at $3 to $8. So definitely something that has helped them a lot. They also are supposedly going to get some money from the settlement because they had to lose their Quebec assets. So the government of Quebec is now paying out these companies for taking over the assets and abandoning them. So they can get X amount of millions of dollars from that. And the company trades as it's worth only $30 million as a market cap. So yeah, so I did end up taking a position. It's very hard to find shares but it took me quite a while to build up to my weighting. Not quite a while, but enough time. And I'll talk more about that in another session here once I talk to management more. Their CEO came from Grand Tierra and is going to turn the ship around. There's not many CEOs that have that in-depth knowledge of their company's operations as Tony does. So, I grilled him on engineering questions, technical questions, financial questions, the warrants, the debt, everything. And he knew what he's talking about. For someone who has only been at the company for a year and a half, not very long, his answers were on point. And I can definitely respect management like that. Vermilion, I've spoken about Vermilion a lot. It's a great company to begin with. Check out my deep dive from last month, April 2nd, I believe, for all the information on Vermilion, because I can't accurately summarize it in enough time that it's better to just watch the video and everything there. Can you explain your well profitability of Tamarack Valley? Baytex Peavine is way better than anything out there. Like, that is the best acreage out there, as long as they can keep drilling wells like that. Tamarack Valley wells are probably less than half as good, but they still pay out in 45, 60 days. So that is how it is. It's still going to make a ton of money. And Tamarack also has a big position in Peavine. So can they delineate that and hit wells like Baytex? Yeah, for sure. Why do you have a position in Surge? Again, I'm going to refer you back to the other presentations. I talk about Surge a lot. There's a lot of things I like in Surge, including the management, the asset quality, the acquisitions they've made. And I think one only needs to look at the latest corporate update on the Q1 report. They're doing a lot. They're not just sitting around and saying, "Oh, we made this much money and we're going to do this," and then end the presentation. No, they tell you they're refinancing debt, they're buying land, they're changing their drilling schedule a bit. They've dealt with this fire in the battery. The Southeast Saskatchewan is going well. The multi-leg horizontals are going well. They've got a dividend upcoming. They're busy. They're working for me. That's why I pay them as a shareholder. That's what I like. Any updates on PetroNinja for Westcan's drilling? No, I don't have any updates on that. Weather in Provost is looking really good. Really, really good. It's drying up real nice. I would expect them to start drilling in the next 2 weeks. Somewhere in the next 2 weeks, I would think that rig's out there drilling. Yeah. Again, what do you think about Razor Energy? There's a deep dive. I went through the entire company and why I like it in there. I'm not going to give a price target out because, yeah, people think I'm crazy. Athabasca results, pretty status quo. Keep in mind their production is declining from Q1. So Q1 was their high point for the year. Just keep that in mind. The great assets don't like management at all. And I could not be convinced to buy Athabasca again. Even though it's done really well for me in the past, a lot, really, really well for me. Headwater's well results in the Martin Hills, their core are really strong. Their other results, as far as I understand, again, I don't spend a lot of time on Headwater because I just don't care what the valuation they're at. But as far as I understand, their other wells outside their core are just not panning out, like less than 100 barrels a day, IP30s. It's good, but it doesn't warrant the valuation at all. $140,000 a flowing barrel or something's flowing at, yeah. Yes, I did cover Journey Energy in one of my valuation sessions. Yep. I just have too many other names that are like Journey. i3 Energy, Surge, Obsidian now, with like scattered assets and these conventional wells. Prairie Provident now, right? Not saying Journey is bad, not saying it's undervalued, not saying it's overvalued. There's other names where I know management better and I know the assets a lot better. Antero, I know nothing about US companies and their assets, I'll be honest. And I don't even want to get into it because I feel if I start tracking US companies, the quality of my work is just going to go down. And I don't want to buy shell companies anyway. Or American companies to begin with. You know, have I missed out on some gains because of that? Yes, but I've still made lots of cash, and I've slept better, and I'm happy with it. Not wondering when is management going to screw me over, or lying to me, or the well is going to blow up. Shale is a completely different world. A lot of things in American shale, they get away with saying certain things about their wells and their assets that Canadian companies can't get away with. Apache and Alpine High is your number one example right there, a complete disaster. Service company questions. I'm warming up to it. I'm warming up to service companies, but I'm still not going to buy anything in the majors. The Tricans, the PDs, they just don't attract me. If there's a smaller service company that's selling something that's non-drilling, that's not reliant on day rates, you could get me interested, yeah. Like somebody selling a certain part of the service side that's a tool, somebody selling pumps, somebody selling frac sand. Yeah, I think that's where the margins can really ramp up, not drilling. PD themselves said rates are 30 grand a day. They think they can get to 35, 40. Does that move the needle on a company with that valuation? No, not in my opinion anyway. Spoke with Derek Christie. They got assets that could be a CO2 pipeline, lots of oil plays. Surge has lots of assets near to Weyburn and Midale. Yeah, just an extra tick on the box. I've talked about CO2 being the next thing here. And yeah, that's great. That's really great. I will talk to Derek again. I know he's a very technically focused guy, so I will definitely check it out. What is a move on PPR? Yeah, like I discussed here, it's more, the price targets don't paint a pretty picture, but if they get somewhere in the tens of millions of dollars for their Quebec decision, they're getting an extra $5 to $7 million a year from their gas now, from the gas production. And once they go unhedged into 2023, that's 3,000 barrels going from making $60 a barrel to whatever you want to take as a price, 120, let's just say $100. So an extra $30 a barrel for 3,000 barrels. Yeah, 3,000 barrels times $30, 100 grand a day. That's $36.5 million a year extra in 2023 compared to 2022 on a company that has a market cap of $30 million right now. Yeah, the price targets are rolling 12-month targets as of the latest quarterly result. So they only take into account 2022. But when we start adding 2023 quarters in here, I think some of the targets are going to change considerably. And yeah, and that's how I've always invested, really. Like Surge, I bought for the same reasoning that something was going to change here. Spartan Delta, Vermilion, I have a very similar style of investment, is get into companies early that are going to have these inflection points and just hold them and let them drill really good well results, let the hedging roll off, let them pay off the debt on some of them, save on interest costs, potentially be in the headlines, putting out dividends. It's worked out really, really well. Headwater, I don't think the well results are good. No, the ones outside their core acreage, but I don't want to comment too much on it because I haven't done the work on Headwater. What is your reaction to broad-based market sell-off? It could fall further, yes. Both oil and gas and the broad market could fall further, definitely. But so far this year, oil and gas has held up really well. And what I want these companies to do is, if the general broad market sell-off starts bringing oil and gas names down, they better be ramping up that share buyback and supporting the stock price. Investors should not have to deal with this volatility when they're making all this money and they're not putting it to work. So I'm definitely going to be pushing hard if something like that happens. At the same time, I don't think the broad market is going to collapse either. People are very, very bearish. People are talking about all kinds of things and, the collapse of tech and collapse of this, like, yeah, it could happen. But I also think it's not going to be this huge collapse that destroys the economy and destroys the stock market. Sorry about that. So I'm not too concerned. And the oil and gas names have held up really well. And if they're paying dividends, they're going to be doing the share buybacks. I think the stock price should hold up relatively well still. Taking profits now and watching the broad market stabilize or go down slowly. Meanwhile, oil price goes to 120, 130, and the stocks go up 20, 30, 40%. Yeah, I can't take that chance. There's no way. It's just not worth the effort to be going in and out of these names because it's easy to miss the big run-ups. Thoughts on ROK Resources? I honestly don't follow them too much. I like the names that are a little bit bigger, like i3, that 15, 20,000 BOEs a day. ROK is just too small. And great company, great management, lots of insider holdings. So they're with you, but I think they're going to make more acquisitions, more dilution coming. So I'm a little nervous after what happened with some other names that ended up doing a bunch of dilution and putting out warrants and such. This idea yesterday was to buy MEG 2024 $9 calls. I prefer the shares. I'll be honest. I prefer the shares. If I'm going to be taking such a low leverage on these MEG calls, why bother? I'll stick with the shares. That way I'm not worried about 2024. 2024 is not far away. It's only 18 months away. And we all know, we think where oil price is going to go and how much money these companies are going to make. But if I'm not getting huge leverage on these calls, I'm not going to bother with putting a time on it and restricting myself to January 2024. It's always there, no matter what people say, it's always in the back of your mind as an investor when you have options versus just a straight equity, which I think the straight equity does really well too, to begin with. And in case of a buyout, I'm also getting the upside, which maybe could be lost in the options. I haven't run the numbers, but potentially, yeah. Are any of these companies working to get US tickers? I don't know. I honestly don't know the answer to that. I think Obsidian just listed on the US side, but I don't know. Price target on Westcan, I don't have a price target. It's a one drill play, which I've done a lot of due diligence on, and depends how the well comes out. Really, that's what's going to matter at the end of the day. I can't put a price target on it when I don't know what the well is going to come out to be. But I did share in my Westcan and Razor presentation, I did share what the cash flows are going to be depending on what the well comes out at, and you feel free to put your own multiple on it and convert that back to share price. And I'll leave it at that. I don't want to talk too much on that. Thoughts on Cardinal? We'll see what happens. It's, again, I prefer i3, I prefer Surge, I prefer Obsidian. Cardinal, I don't think the governance structure is very strong. We'll see what kind of dividend they come out with. So yeah, we'll see. I'm looking forward to it, but I don't think I'd buy Cardinal ever, when I can buy other better companies in a way, in my opinion. There's a question here on Gear Energy. I've spoken about Gear as well. I think it's overvalued by a long shot, so I don't focus on it. Their new Lloydminster multilaterals didn't come out very strong. Like, they're still really great wells, but they're not game-changing wells. So it just doesn't get me interested at this point. Do you agree with Dr. Al-Haji on how will recession affect WTI, 400K barrels per day? I haven't really pinpointed a number, and I don't really think it matters, to be honest with you, because all that matters for oil price is the difference between supply and demand and how fast our inventory is dropping. That's all, in my opinion, that really matters. Like, we can discuss whether recession is going to drop demand by 2 million or 1 million or 400,000. Okay, well, if demand drops by 400,000 in a recession, but Chinese demand goes up 1 million barrels a day and world supply goes down 1 million barrels a day because the Houthis blew up something in Saudi Arabia. The point is moot, how much the recession lost the barrels. It's about, at that date and time, what's the difference between supply and demand and how fast are inventories dropping? That's all I look at. I don't get into the nitty gritties, and I respect Dr. Alhaji a lot, and I respect his take on this. And for anyone that's looking for a number, I would definitely say that, you know, he's probably doing some of the best work in this sort of calculation, but I've never even thought about it this way, because so much more can change and so much more can happen. As soon as the world oil supply demand deficit gets to less than 0.5 million barrels a day, I think it's time to pay attention. It's going to be time to pay attention, think about trimming positions and potentially exiting if that's going to be the space we're in. We're not there yet. We're not even close. We're not even close to getting to that on a sustained level, I should say. We might be there today because China shut down, because Russian barrels have not really come off the market yet. We might be there, but I don't see a line of sight to us staying below 0.5 million barrels a day of undersupply for the near future. Yeah, frustrated with ARC. Yeah, you are too. Yeah, we'll likely take that dollar and go elsewhere for sure. Okay, there's a question on Hemisphere. So I was supposed to meet the management of Hemisphere at this conference last week in Vegas, but it ended up there's some issues and I couldn't make it. So yeah, well, I'm not tracking it because I think the company is just going to be unloved forever. Even if they have high free cash flow, it's just too small to be in people's eyes. So I haven't really spent much time on it, but the polymer flood, seems to be doing well, and production is going to do well from it. So, you know, I think the company is going to do really, really well, and then they might even go out and privatize themselves or just pay out like a 20% dividend every year, because what else are they going to do with the cash? So it doesn't excite me just because of the way it moves, but definitely if somebody wants a low risk name you just want to leave in there for the next 2, 3, 4 years, yeah, why not? For sure. Okay, so if we come back to capital expenditures, Obsidian guided for 145 in 2022. They've already done 100 million. I'll have to look into that, but that might include the acquisition as well. In the capital that they're saying they did in Q1, it might include the acquisition, but they spent a lot of money in Q1 for sure. They spent a ton of cash, like they were drilling, completing lots of stuff. So that might actually not even be wrong. Yeah, they were busy. Like production is really, really good at Obsidian right now compared to what they reported in Q1. I think the production is already up 15% more than that. So that might not be wrong actually. Have you looked at Trillion Energy? No, that's in Turkey, I believe, or yeah, no, I haven't looked into that. Anything with warrants attached to it in the deal, which I believe Trillion was, I just don't buy them. Okay, I'll take a few more questions here, but we'll try and wrap this up here. I was there for Michael Blair's presentation yesterday. Amazing, just amazing. The real world experience and the actual history and doing stuff and building companies. You can't buy that sort of experience. You have to have done it and taken risks and accomplished. So definitely respect his views for sure on basically everything. And I listened with very close attention. He thinks debt is a disease. Yep, and he's right. A lot of companies that took on a lot of debt ended up going bankrupt or losing a ton of cash for their shareholders. However, what you'll find is a lot of these companies that went bankrupt took on debt in 2013, 2014, just before the oil price collapsed. Any industry, it doesn't matter what industry you're in, you take on debt and then the price of oil collapses, the price for your commodity collapses, you're going to go bankrupt either way. It doesn't really matter. We're, I think, in a different regime right now. We're in very low interest rates, and we have line of sight, I believe, to a structurally strong bull cycle even if there's a worldwide recession for a while here. So in my opinion, things are a little bit different. And again, not to downplay anyone, but he grew up in a time of 15, 18% interest rates and uncertainty around oil price. When the price used to go high, they would fall just as fast. I just think we're in a different regime now. Oil prices are in a different outlook in terms of supply and demand. So yeah, I'll bet against that. And I'm happy to bet on companies with high debt. Not saying that's going to work for everyone, but I'm definitely looking for companies with high debt and high decommissioning liability and no plan to pay off the debt, like reduce it to this or bring it to that. Bank debt, I'm a little careful with. Companies with too much bank debt, you want to be careful with. But term debt till 2026, don't even worry. I'm not even worried because there's not going to be a 5-year recession. There's no way. And prices are going to be sustained higher in the next 5 years. I don't know what they're going to be at, but I'm very comfortable holding on to higher debt companies for sure. And again, to each their own. I'm not saying that's how you should be doing it, or that's the best way to do it, or even the right way to do it. It's just what I feel comfortable with, based on what I know and what I'm looking at the market here with. Baytex has good assets. Yeah, Baytex has really good assets, but the hedging situation kind of not the best, and the valuation is a little high. It's a little high compared to their peers. I think I'm finding better deals elsewhere right now. I heard Disney in Shanghai is opening. Good. Well, the world will realize how undersupplied the market really is once China opens into May, June, July here. Yeah, it's not going to be fun for the consumer at all, but that's how the market is, and I'm investing accordingly. So don't you think that reducing debt so hard for certain companies isn't the best way to go? Yeah, I'm right with you. I'm right with you. Take on more debt. Look at what Vermilion just did. They took on more debt. I was so happy to see somebody bucking the trend and going at it. And I'm not saying they should be all growing production with the debt, like not pay back debt and then just start growing production and jam out wells. No, definitely not. But I think companies that are guiding to way too low of a debt are just not playing it the right way. And I've spoken about this before, where if you're paying off debt at 3%, when inflation is at 9% or whatever number, the real cost of it is negative and you're paying it off, that tells me you as a management team are not competent, that you can make, are not competent and not confident enough that you can make more than that 3% or 4% or 5%. And then you go out and give yourself huge options and bonuses and warrants. Yeah, I'm keeping a close eye on this sort of thing. And I will definitely call it out for sure. If you could only hold one company, which would you hold? The one that's the majority of my portfolio and is a top performer year to date, Surge. That's a company that's going to do the best, I believe, going forward as well. I mean, Obsidian's trading at such a low valuation that maybe the cash flows speak for themselves. But yeah, if I could only hold one right now, Surge. 70% of my personal portfolio right now is in Surge. So I think I'll definitely agree with that. And yeah, how much of the hedging is required? That's an old excuse that the companies wanted it, the banks wanted us to hedge and we had to hedge and all this. That was a 2021 thing. Don't be pushing, and I'm not saying you are, but any company that's talking about this now, don't be giving me that. That's total BS. Yeah, especially at these prices. So yeah, a little bit different. Would you be able to modify the target prices? Yeah, I'm definitely going to be working on it. Yep. There's been a lot of Q1 results out, and this week there's a bunch more. What I'd like to do is when I do those templates, I'd rather do 20, 30 companies at once, because as you saw, the first one took us an hour. The second one took us 10 minutes. Once I'm in the zone, I can crank them out and figure out what's going on with the Q1 results. I don't I don't like to do 5 at a time and then stop and then do 5. It just kills the momentum, really. Yeah, there you go. There you go, Dirk, right there. That's the best way to put it. If I can take debt at 3% and buy shares in Surge all day long, if I can take debt at 5% and buy shares in Vermilion, Whitecap, whatever, all day long, all day long. So that's the same as a company paying off its own debt instead of buying back its shares. They're telling me that that it's not worth it for them to pay 3 to 5% interest and buy back shares. If that's what they're telling me, definitely loses confidence in what they think the company is worth and what it should be worth. Yeah. Very interesting way to think about it, for sure. Like, think about your own investments. Would you take a loan at 3 to 5% to buy shares in a company? I think a lot of people would say yes. Yeah, but anyway, so that's that. Thank you so much again for attending and joining for these. Again, we have May 21st, we got Kelt, Crew, and Advantage. And May 28th, some due diligence ones. This recording will be up here shortly. Any other questions, feel free to call, email me. I've been getting lots of messages. I've been trying to keep up with them. And it's like, I'm in Vegas this week. I met two investors that I met off Twitter. Went for steaks and drinks, and it was a great time, and talked oil. So nothing really better than that. So yeah, for sure. Appreciate your time again, and we will see you all at the next one. Cheers. Thanks again, Dirk, for co-hosting. I always appreciate your time, and I keep saying that we should talk, and I never email you back. So we'll do that here shortly. And yeah, thanks again. Hope everyone has a great rest of your weekend and a great week ahead.